Hello, friends. Hello, students. A very good evening to you. So, today it's our last lecture on chapter 15 assessment procedure. Till now, what we have all studied is hmm, we have studied the provisions related to return of income. Then we studied assessment procedure in the last two classes. I hope these two topics are clear to you. In case you have any doubt, do let me know. Okay. So in the return of income, we studied who all are required to furnish return of income, and then what are the due dates by which the return of income should be filed. Then in such topic, we also studied different types of return of income: loss return, belated return, revised return, defective return, updated return, and a modified return. Okay. Then we also studied who are the person who are exempted from the requirement of filing return of income. Okay. If you ask me from the exam point of view, the topic of updated return and section 139(1), who all are required to furnish return of income, are comparatively more important than the others. Okay. Then we also understand that how the tax on updated income is calculated. There is an amendment in case of updated return that which is relevant for your attempt is that now updated return can be filed for 4 years. Okay, 4 years from the end of revenue assessment year. Earlier it was 2. And but the additional tax has also increased. So in case of updated return, if you file the updated return within 1 year from the end of relevant assessment year, then the additional tax is 25%. In second year, 50%, third year, 60%, and the last year, 70%. Okay. So broadly, this we studied in class 1. In class 2, we studied about different types of assessments. We studied the section 142, where the AO issues notice for collecting some information or for asking for return of income because SC has not furnished the return of income. Then we studied the processing of return under section 143(1), very important. Then the most popular assessment, scrutiny assessment under section 143(3). Then the best judgment assessment, section 144. And then we studied the income escaping assessment under section 147. So all the assessment procedure is actually the soul of this chapter, assessment procedure, which we studied. If I ask you in which all section you can file return of income, so there are exhaustively only 4 sections which allows you to furnish return of income. One is 139, where you furnish return of income. Then 142(1), where the AO issues notice asking assessee to furnish return of income. Then 148, and lastly, in case of search. We have studied all these 3. For the 4th one, we will do it today. Similarly, assessment can also be made only in 4 sections. One is 143(3), scrutiny assessment, 144, best judgment assessment, 147, income escaping assessment, and lastly, assessment in the case of search. Here also we have studied the first 3 assessment, and today we will cover the search assessment. Hope I am clear. Okay. So there's also one more assessment, the summary assessment. No, students. The summary assessment is not called the assessment, it's the intimation. We loosely, as a layman, call summary assessment, but law doesn't recognize it as an assessment. It's an intimation. It's a processing of return under section 143(1). So even if intimation has been issued under section 143(1), meaning thereby summary assessment has been done, still I can revise my return. You understand? So it's not a assessment which the law recognizes. Okay. So students, before starting today's class, let's understand what's the process of assessment. We briefly touched it in first class as well. We today also will touch what's the process of assessment. So in assessment, what happens? What is the process? So, firstly, the assessee furnished return of income. He may or he may not. Then, assessment happens in any of the above sections. Then, there is a if assessee is not happy with the assessment order, is aggrieved by the assessment order, then he can file an appeal. There are multiple hierarchy where the appeal can be filed. The first appeal is filed to the CIT appeal, Commissioner of Income Tax appeal. Then, against the order of Commissioner Income Tax appeal, an appeal is filed before the ITAT. Then to the High Court, and then to the Supreme Court. Okay. We know that there is a time limit by which the AO, the assessing officer, can complete the assessment procedure. We studied this in last class as well. So generally is 12 months from the end of the relevant assessment year in case of scrutiny assessment and best judgment assessment. Okay. But my dear students, is there any time limit for the commissioner appeal to pass its order to dispose of the appeal? Say an assessee furnished return of income, his return is picked up for the assessment. Okay. AO makes the assessment and assessee feels that AO is not fair and the additions made by the AO is not legally correct. So I as an assessee file an appeal before the CIT appeal. Now the question is there any time limit by which the CIT appeal is required to pass an order? So my dear friends, there is no time limit for the CIT appeal. There is a time limit for the assessee to file an appeal before the commissioner appeals. But there is no time limit for commissioner appeal to pass an order. Okay. So what happens is it takes years and years and years to get the issue settled. So there is no time limit neither for CIT appeal nor for ITAT, High Court or Supreme Court to pass order. So every authority takes sufficient time, take a lot of time because of the pendency of the cases or many other reasons. And so a issue gets finally settled at the level of Supreme Court or High Court, it takes 15 to 20 years to actually get the issue settled. Now you know the non-residents or the foreign companies, FCs, they what they prefer. Tell me one thing. What they prefer? Do they prefer the low tax? They may prefer low tax, but let me tell you, they more prefer the certainty. They prefer the certainty in their dealings. So before making an investment in India, they must know what are the tax impact, what are my costs, and what are my revenues. But in India, the tax is the most uncertain thing. And if assessing officer make any addition which may not be very much legal or which the foreign company may not agree upon, then it will take 15 to 20 years and maybe more than that for the foreign company to actually get the certainty whether tax is leviable or not. This is a deal breaker. This the foreign company doesn't want. This the foreign company doesn't like. They don't like this. So what the and we know we studied in the first class in the return of income as well that the government wants to help the non-resident foreign companies by way of reducing the compliances. So in that path only, what the government did is they bring a concept of DRP. This is dispute resolution panel. What is it? This is an alternative mechanism to resolve the dispute only for foreign companies or entities. We will go in detail. So what we do is let's first understand first understand what the DRP is, what the procedure is, then we'll study the notes. Yeah? So it will help us. But let's first understand what's the DRP, what's the mechanism. So my DRP provision are contained in the section 144C. You need not to remember the section. So firstly, why DRP is introduced? So what is DRP? DRP is a panel of three commissioners, three officers of the rank of commissioners or principal commissioners. They form a panel and they hear the argument of the assessee against the assessment order. So it's something equivalent to appeal before CIT appeal. So what happens is that if you are an eligible assessee, we will study in a minute what is eligible assessee, who is eligible assessee. If you are an eligible assessee, then after the assessment, you have two options, my friends. So students, you have two options if you are an eligible assessee. What are the two options? One, either you can file an appeal before the CIT appeal, Commissioner of Income Tax appeal, or you can file objection before the DRP. So we use the word appeal when we refer to the CIT appeal. We use the word objections when we refer to the DRP. So an assessee who has been served with the assessment order, he has two options. He can either file an appeal before the CIT appeal or he can file an objection before the DRP. Okay. So what's the difference? The major difference is, my dear friend, the major difference is there is no time limit. No time limit for the CIT appeal to pass an order. But there is a time limit for the DRP. And that time limit is very limited, 9 months only. We'll go in detail. There is a time limit. Another difference, or very important difference. Say, CIT appeal orders in the favor of foreign company, in the favor of SSC, and he deleted the addition made by the AO. Then, is the issue settled? No. The department can file an appeal against the CIT appeal order. Now, what I'm saying, why will department go appeal against the office, its own officer? No, it happens. Because when CIT appeal hears an appeal, he acts fairly, unbiasedly. So though he is an officer of the income tax department, but he acts unbiasedly. So CITP may allow the claim or may not allow the claim. If CITP allows the claim, then the department may file an appeal against the CIT appeal order itself before the ITAT. Or if CITP doesn't allow the claim, of course, assessee can go to the ITAT. So against the order of CIT appeal, both assessee and department can file an appeal. So, assuming CIT appeal gives a relief to the foreign company and department file an appeal before the ITAT, issue is again uncertain. So this was the issue, this was the problem which the foreign companies were facing. So one thing is there was no time limit for passing the order before CIT appeal. What the DRP says, it has a time limit. DRP has to pass an order within a specified time limit. Secondly, the department cannot file an appeal before against the directions of DRP. So if DRP has given some directions and if it's in favor of the assessee, then the issue is settled. No more appeal. This is what the foreign companies wanted. I want a settlement of my issue in a specified time limit. I cannot let the issue hang on for perpetuity. Let me have a certainty. What's my cost? I don't want that 25 years after the transaction, I receive a demand notice of 100 crores. This was a problem with the foreign company. I should know now what's my tax implication, what's my tax cost. So just to encourage foreign companies to invest in India, this DRP provision scheme. Okay. So one thing, there is time limit by which the DRP shall pass the direction. And secondly, department cannot file an appeal against the DRP directions. Tell me one thing, if assessee is not happy, is aggrieved by the DRP direction, and he wants to file an appeal against the direction, then whether he should file an appeal to the CIT appeal or to the ITAP. Of course, the first level of appeal is CIT appeal. No, my dear friends, understand the concept. DRP is a panel of 3 commissioners. See, everything makes a logic. When I said that DRP is a panel of 3 commissioners, I said it. You can use that now. DRP is a panel of 3 commissioners. Understood? And my CIT appeal is equivalent to the rank of commissioners. CIT, you know that? Yeah, yes, Geeta, Miss Geeta. She has said that the appeal shall lie to the ITAT. Good. Now I'm telling you the reason why the appeal shall lie to the ITAT. Because the DRP consists of 3 commissioners. Commissioners are equivalent officer to the commissioner appeals. So an appeal normally lies to a senior officer. Against an order of a junior officer, appeal lies to a senior officer. So against an order of CIT, an appeal cannot lie to an equivalent officer, which is CIT appeal. And therefore, the appeal against the directions, no, there is no appeal against direction. I'll come in a minute. Appeal against the DRP can only be filed before. Yes, absolutely, Gita. So they are same in hierarchy. Can file before ITAT. And that too only by the assessee and not by the department. Okay, understood? So these two things make the DRP attractive. There are other practical considerations which you will need to consider before deciding the CIT appeal and DRP. So secondly, who can file an appeal, who can go to the DRP? So who is eligible assessee? The eligible assessee, we have understood the concept. So we know who is eligible assessee broadly. The eligible assessee is what? Non-resident, non-corporate, non-resident, or a foreign company, or any other person in whose case the variation has taken place, variation has occurred, the addition is made on account of order of TPO. TPO means transfer pricing or officer. So what happens there? If there is a transfer pricing transaction, then the AO may refer the case to a TPO to compute the arm's length price of such transaction. Okay, you're with me? And TPO would pass an order determines arm's length price of such transaction. And such order, the assessing officer shall then pass the final assessment order, the complete assessment order, incorporating the TPO order. Okay. So if either the assessee is non-resident or a foreign company, then he is an eligible assessee. He has the option to either go to the CIT appeal or to a DRP. You are with me? DRP is not mandatory. Assessee has an option. He can go to CIT appeal as well. The foreign company has an option. Foreign company can appeal to the CIT appeal and not to the DRP. But this is an option. Or in case of any other assessee in whose case the adjustment is made on account of the TPO order, transfer pricing officer order. Okay. Let me know if there is any doubt. I'm going slow so that you could absorb it. Tell me one thing. If there is no TP addition in the hands of foreign company, can still foreign company go for the DRP route? Of course, because for the foreign company, there is no condition that the addition has to be on account of by reason of in pursuance of TP order. So foreign company by itself in every case is eligible to go for the DRP route. But see, once you study the TP, you will realize that it's not mandatory for the assessing officer to refer the case to the TPO if there is international transaction. AO may, in rare cases, AO may himself compute the arm's length price. But if AO himself computes the arm's length price and makes an addition, then in such case, the assessee cannot go for the TPO, for the DRP route, unless it's a foreign company or non-resident. Okay, you with me? So the eligible assessee, there are two types of eligible assessee. Either you are a foreign company or non-resident, or in your case, the addition is made in pursuance to the TPO order. You're with me? Understood? Good. Okay. So what's the process in the case of DRP route? So what is the process is that DRP is an extension of assessment only. It's not a in the form of appeal. Okay. So what the law says, in case of eligible assessee, these two type of assessee, it is mandatory for the AO to pass draft order. The AO will not pass the final assessment order. He will pass the draft assessment order. Draft means he will not finalize the order. He will say, as per me, you furnish your return of income for this much amount, and these are addition which I am proposing to your return income. Okay. So he will pass draft assessment order if the assessee is an eligible assessee. Now, once the assessee receives draft assessment order, the assessee has an option. Either he will accept the variation, the addition and offer, or he may file objections before DR. So if he wants to go to the CIT appeal route, he will accept the variation, ask the assessing officer to finalize its order, and against such final order, the assessee will file an appeal to the CIT appeal. Or if he wants to go to the DRP route, he will not accept the variation. He will file the objection before DRP. And for this, the assessee has a time of 30 days from the date of receipt of the draft order. So once an order is received, say order is received on 15th March 27, then the assessee has up to 14th April 27. He can either file an objection before the DRP, or he can file a letter to the AO that I accept the order. Okay. Now assuming, so assessee has two options. He will accept the variation, or he will file an objection before DRP. Understood? If he file an objection before the DRP, then AO need not do anything. He will wait for the DRP proceedings. Let the DRP decide whatever they want to say. But if assessee accept the variation, or assessee did not do anything, doesn't do anything between this period, neither accept the variation nor file an objection, 30 periods lapse. In both these cases, either he accepts the variation or he doesn't do anything. Doesn't do anything. In either of these cases, AO has to finalize the order, of course. If the assessee has not approached to a DRP, has not opted for a DRP route, then as an AO, I will finalize my order. And the time limit of finalization of order is 1 month from the end of the month in which I received the acceptance, or end of the month in which this 30 days period expired. So in our example, the AO issued the draft order on 15th March 27, right? Against this, assuming the assessee filed an acceptance on 31st March 27 or 4th April 27, or didn't do anything. Neither file an objection before the DRP nor file an acceptance with the AO. Now, in all these three cases, tell me what is the time limit by which the AO has to pass the final assessment order. I'll tell you. So, time limit is 1 month from the end of the month in which acceptance is received, or 1 month from the end of the month in which this 30 days period expires. So, in first two cases, acceptance is received. So I'll add that month and add 1 month. So in first case, the AO can pass an order up to 30th April 27. In second case, he can pass, I'll add the month of April and add 1 month, 31st May 27. And lastly, he can pass within 1 month from the end of the month in which 30 days expire. So my 30 days expires on 14th April. So I'll end that month, 30th April, and I will add 1 month. So again 31st May 27. So you are with me? Any doubt? Let me know. So for assessee, it's a time of 30 days from the date of receipt of draft order. And for AO to pass the final order, it's 1 month from the end of the month in which he receives the acceptance. So you understood now? Either if he receives the acceptance in the month of March, he will pass an order by 30th April. But if he receives on 4th April, then he has a time till 31st May. You are with me? Now, what happens at DRP level? Assuming assessee files an objection before the DRP within this 30 days. So he had 30 days and I opt for the DRP route. I am not going for the CRTP route. So what will happen? So I will file my detailed objections against the draft assessment order before the DRP. What the DRP will do? He will do a hearing. He will listen to me. He will consider draft order which the AO has passed. He will consider all the material which the AO has relied. He will consider rather they will consider, DRP is a panel, it's not a single officer. They will consider the valuation report or the TPO order, any other thing which happened during the course of assessment before the AO. DRP can make inquiries independently or may ask any officer to make inquiries on its behalf. So he may make inquiry. He may seek any information or may ask any officer to seek the information. So relying on all these material, DRP will issue a direction. See, DRP is not an order, it's a direction. It's only a direction. So since it's not an order, no appeal can be filed against the DRP direction. So how we can challenge the DRP direction? I'll tell you in a minute. Okay, you're with me? So all these hearings happens, the assessee files submission, the DRP asks questions, DRP makes inquiry, assessee submits the information and finally DRP issues direction. Let me know if there is any doubt. So after hearing everybody, DRP issues a direction. Before issuing a direction, it's mandatory that DRP gives an opportunity of being heard to the assessee and AO. We discuss principle of natural justice. So no party can be punished unheard. Okay? So before issuing direction, it's mandatory that the DRP gives an opportunity of being heard to the assessee and the AO. Okay. So once the DRP issues the directions, then AO is mandatorily required to pass a final assessment order in conformity with the directions of the DRP. Conformity of the directions of DRP. So now those directions are binding on the AO. AO cannot deviate. So once DRP has issued a direction, those directions become binding on the AO and AO shall finalize the assessment order on the basis of direction issued by DRP. Okay. And assessee can appeal. Now this can appeal against this order. This is an order. This is not a direction. So now assessee can appeal against this order. So this is the way assessee goes to appeal against a DRP. But this appeal against this final assessment order, though it's been passed by the AO, but the appeal lies to the ICAI. You know why? Because it's being passed in conformity with the directions issued by DRP, which is a panel of officer equivalent to the rank of principal commissioner with people. Okay, you're with me? What's the time limit? Yes, we discussed. There's a time limit of 9 months for the DRP to issue direction. 9 months from the end of the month in which draft order was passed. And once the directions are issued, the AO has time limit of 1 month. Similar. In earlier also, it has a time limit of 1 month. Now also it has a time limit of 1 month to pass the final order. You with me? Okay, students. Tell me, my friends, one more thing. What the DRP can do? I'll give you an option. See, there is a foreign company, say Apple. Apple assessment of assessing officer make an assessment, and what he does is that there was five types of expense: expense A, B, C, D, and E. What the AO does is that AO allows the expense A and disallows expense B, C, D, and E. Okay. Now, what the assessee does, he was not agreed by the expense B, so he filed objection before the DRP only in respect of expenses D, C, D, and E. You're with me? So, assessee claimed five types of expenses A, B, C, D, E. AO allows expense A and disallows expense B to E. The four expenses. What the assessee does is, assessee was agreeable to the disallowance of expense B. He files an appeal in respect of expense C, D, and E. Okay. Now, the question comes whether the direction in respect of issued by the DRP has to be limited to C, D, and E, or can DRP go beyond? So, yes, the DRP can go beyond, but only in favor of department. So, what the law says, the DRP has to decide about CDE. Of course, he has to. There is no option. DRP can disallow expense A as well, which the AO has allowed. If the expense A was a part of assessment order, assessment proceeding, then DRP can enhance the assessment. See, the AO has made the addition in respect of C, D, and E. But DRP has a power to enhance the assessment as well, and it can disallow expense A, though which was allowed by assessing officer. But DRP cannot touch expense B. He cannot allow expense B even if he feels that expense B is wrongly disallowed. You understand me? So he can enhance, he can bring the new source which was there in the course of assessment proceeding, but not form part of draft assessment order. But whatever addition has been made by the AO, and if such addition is not objected before the DRP, in such case DRP cannot give a relief in respect of such addition which has not been raised before the DRP by the assessor. So you are with me? So in this case, expense B was disallowed by the AO, but assessee did not file an objection against expense B before the DRP. And therefore, DRP cannot now allow expense B. Though DRP can disallow expense A, which was allowed by AO. So what the DRP can do? He can confirm the order of AO. DRP can say CDE was rightly disallowed. He can reduce, he can relieve, he can say that CDE was allowable, or he can say that, they can say that expense C and D should be allowable, expense E should be disallowed. Or it can enhance. Understood the meaning of enhance? It can disallow the expense which the AO allowed. Okay? But DRP cannot set aside. See, we want conformity within the time limit. Now, don't play this game. I will set aside, AO will make a fresh assessment, then again, against that fresh assessment, assessee will file an objection before DRP. So, no to and fro. DRP has to give a direction whether it's allowing, it's agreeing to the objection of assessee or not. So it doesn't have power to set aside, nor DRP can say to the assessing officer that make inquiry and then pass assessment order. No. You make inquiry, you can use the assessing officer to make the inquiry before yourself. But you have to pass a final direction in conformity with the same, the AO shall pass the final assessment order. Let me know if there is any doubt. So what happens is that, if I briefly discuss again, that in case of eligible assessee, foreign company or non-resident, or an assessee in whose case the addition is made on account of TP order, he has two options, CIT appeal or DRP. So in the case of eligible assessee, the AO pass draft order. Is it mandatory for the AO to pass a draft order? Absolutely, sir. If you are an eligible assessee and AO pass a final order, then that order is void. For eligible assessee, the AO cannot take away the right from the assessee to go to the DRP. So he has to pass a draft order. Against the draft order, assessee can either accept the variation or go to the DRP route. And both this thing has to be done within 30 days from the date of receipt of draft order. If assessee accepts the variation, then AO shall pass the final order within 1 month from the end of the month in which he received the acceptance. If assessee goes for the DRP route, then the hearing will happen, and after 9 months, DRP shall issue a direction within 9 months. And once the DRP issue direction, AO is required to pass the order in conformity with the direction, the final order, within 1 month. What happens is that AO pass order after 1 month in pursuance to the DRP direction. And the assessee says that this order is time barred and thus has to be quashed. What the department says, see, what the department takes argument, what the lawyers take argument, you should know this. What he said that I agree with you. The department said, I agree with you that my AO passed belated order. He passed the delayed order. Okay. He should have passed the order within 1 month, but he delayed. But so what? He just has to copy paste the direction. There is nothing changes. Had it been passed within 1 month or is passed after 1 month, no more inquiry was there, no more proceeding was there. He just has to copy and paste the direction. The order has to be passed in conformity with the direction. The directions of DRP are binding on the AO. AO cannot deviate from the directions. So even if it's passed after 1 month, you should accept it, because it's not that AO gets more time and therefore he makes more addition. No, he just copy paste the direction. There was no other option with the AO. This was the argument with the department put forth before the court. But court said no. There is some respect to the timelines given in the act. If that be the case, then who will respect the timelines? So if the AO passed an order after 1 month, then such order is time barred and not leviable. Okay, not enforceable. You're with me? So this was a basic DRP concept. I hope you understand. Now we will study the notes. So DRP. Reference to DRP. You understand? DRP is only an extended assessment. The DRP direction gets merged with the order of the AO. Ultimately, it's the final order of AO, which is the final, okay, which includes the direction of DRP. So where it's written? It's written in section 144C. An eligible assessee has following two options in case AO makes variation in its return income. Option 1, CIT appeal route, or option 2, DRP route. So for the assessee, is an option. But for an AO, he has to pass draft assessment order. It's mandatory for him. In case of eligible assessee, AO shall forward draft of the proposed order of assessment. AO shall, it's mandatory. Draft of the order of proposed adjustment. I hope the notes are clear. It's legible. To the eligible assessee, if AO proposes to make any variation prejudicial to the interest of assessee. So what earlier was there, he was required to pass an draft order only if the variation, he makes a variation in the returned income of such assessee. But subsequently, I think Finance Act 2020, somewhere there, the law changes and the words in the return of income was deleted, and in place of them it says that prejudicial to the interest of assessee. I'll explain. Take an example. What happens is that foreign company has a royalty income from India. Such income the foreign company offers for 15%. But the assessing officer says it's taxable at the normal rate of 35%. Assuming so. So, and in this case, AO did not pass draft order. He did not pass a draft order. Why? Because he said that I have not made any variation in the returned income. The royalty income of rupees 1 crore, which was shown by you in the returned income, which was shown by the foreign company in the returned income, the AO has not made any addition. What the AO has done? It has only increased the tax rate. So there is an increasing tax liability to the foreign company, but there is no change in the returned income. And therefore, AO says, I am not required to go for section 144C. I am not required to pass draft order. He was right. But this, this is against the intent. The foreign company should have an option in this case as well. Even this adjustment is against the SSC, and therefore amendment was made. Now, even if there is no change in the return of income, but the order is somewhere prejudicial to the interest of SSC. Prejudicial means against the interest of the SSC. Then the AO has to pass draft order, and SSC has an option either to go to CIT appeal or to the DRP. Hope I'm clear. You're with me? You're with me? On receipt of draft order, eligible SSC shall within 30 days of such receipt, he has two options, either to accept the variation or file objection before the DRP. Thank you, Geeta ji. Clear. Do make the class interactive. Keep on responding to the chat. Yes, no, whatever you want to say. So it will help you keep focused in the class. Now, AO shall complete the assessment by passing final assessment order on the basis of draft order. When the SSC accepts the variation or he doesn't furnish any reply. If SSC intimates him the acceptance or if no objection are received within the aforesaid period of 30 days. In both these cases, the AO shall finalize the order. The time limit is 1 month from the end of the month in which acceptance is received or aforesaid period of 30 days for final objection expires. So you are with me? We did it with the dates as well. Now, if SSC goes for the DRP route, he doesn't file an objection, doesn't file an acceptance, he files an objection before the DRP. And AO. So what the DRP does? Before issuing any direction, DRP may make such further inquiry as it thinks fit. So law allows DRP to make inquiry over and above the inquiry already made by the AO, or cause any such inquiry to be made by any income tax authority and report the result of the same to it. So either the DRP panel can itself make an inquiry or it can ask any officer to make the inquiry on its behalf. Okay. So I told you DRP is a panel of 3 commissioners. It may happen that the 3 commissioners may not agree on some point. Then that point would be decided on the basis of perfectly majority. So Geeta ma'am is saying that the notes is not available. So I'll upload the notes after the class itself. Okay. No problem. I'll upload the complete notes for the assessment procedure, all the 3 classes after this class. So if the member define their opinion, then the final decision shall be taken on the basis of majority. An opportunity of being heard shall be given to the SSC and AO, ordi altem partem. Means principle of natural justice. No person can be punished unheard. Then opportunity shall be given to the SSC and to the AO as well before issuing any direction, if the direction is prejudicial to the interest of SSC or of revenue respectively. DRP direction. DRP shall issue such direction as it thinks fit for the guidance of AO to enable him to complete the assessment. Though it's written guidance of AO, but it's binding on AO. Okay. DRP, what can DRP do? DRP may confirm, reduce, or enhance the variation proposed in the draft order. Now you understand the meaning of enhance. So either it can confirm whatever the AO has done is rightly done, or it can reduce or enhance. If I tell you practically, in most of the cases, DRP only confirm. If you can think the practical reason why. The reason is, I told you, the reason is the DRP order is final order. So whatever they decide, if they give a relief to the foreign company, then it's become final. They took the onus to give the relief. Department cannot file an appeal against this DRP panel direction. So therefore, practically, they generally don't take very aggressive view in favor of assessing. This is from practical point of view. What a DRP cannot do? The DRP can do confirm, reduce, enhance. What it cannot do? It cannot set aside any proposed variation. DRP cannot issue any direction for further inquiry and passing of assessment order. No. Don't ask AO to make an inquiry and then pass an order. Do your inquiry. Power of DRP to enhance the variation, mind it, shall include power to consider any matter arising out of the assessment proceeding relating to the draft order, notwithstanding that such matter was not raised or whether such matter was raised or not by the eligible assessee. So remember, the expense A which was allowed by AO, still DRP can disallow. Every direction issued by DRP shall be binding on the AO. Though it says for the guidance, but it's binding. No direction shall be issued after 9 months from the end of the month in which draft order is forwarded to the eligible assessee. You understood? So this was a major issue. There was no time limit for CIT appeal. Now DRP has a time to issue direction which is 9 months from the end of the month. Upon receipt of direction, AO shall complete the assessment by passing final assessment order in conformity with the direction. AO has no leeway, no option to deviate from the direction. He has to just copy paste the direction. AO is not required to provide any further opportunity of being heard to the assessee. So AO is not required to provide any opportunity to assessee at the time of passing final order. Why? Because what the assessee will do? He will submit that directions are not appropriate, but AO cannot help it. AO is bound by the direction. So if you are not happy with the directions, then go and do the ITAT. So therefore, no opportunity is required to be given. AO shall pass the order. What's the time limit? Within 1 month from the end of the month in which the direction is received. So in both the cases, AO has time of 1 month. Earlier, when assessee does not choose for the DRP route, there also he has a time of 1 month from the end of the month. And here also it's if he passing the final assessment order in pursuance to the DRP direction, conformity with the DRP direction, then again he has a time limit of 1 month. The provision of this section shall not apply to any assessment, reassessment order passed by AO with the previous approval PCIT or CIT. As provided in section 144BA. So what section 144BA says? It's a GAR, impermissible avoidance agreement. So if an order is passed in accordance with the 144BA, then the DRP route is not available. The provision of this section shall not apply to any proceeding relating to such cases. In such case as well, the DRP route is not available. Dispute resolution panel means a panel comprising of 3 PCITs/CITs constituted by board for this purpose. With a panel of 3 commissioners, very senior officers. Okay. Now, lastly, what is the eligible assessee? Eligible assessee means any person in whose case variation arises as a consequence of the order of TPO. You're with me? Or any non-resident not being a company or any foreign company. So in both these cases, the AO has to pass a draft order. Such eligible assessee shall not include persons referred to in section 158BA. Sorry. So 158BA is in case of such. No, I told you, their provision doesn't apply in case of such. Or other persons referred to 158BD against such. So you're with me? The DRP. So eligible assessee has 2 options, either to go to CIT appeal or to the DRP. In both the cases, in case of eligible assessee, the AO is mandatorily required to pass draft order. Against that draft order, assessee can either accept or file an objection. If he accepts, then AO shall finalize the order. If he file an objection before the DRP, then DRP proceeding would happen. DRP can either confirm, reduce, or enhance the assessment, and he will issue a direction. And such direction are binding on the AO, and within 1 month, AO shall finalize the. So this was a small DRP concept. Hope it goes into your mind and heart. Okay. See, at first, do any concept in detail. Once you do it in detail, once you understand it thoroughly, then it's very easy to retain it. See, we took around 30-40 minutes to explain the DRP, but we took 2 or 3 minutes to revise it. Understood? Now, assessment in such cases. The next topic and very important for exam and also for the practice. So what is search? You know what is search? Read. This is the nuclear bomb which the department has. This is the most powerful thing which the department can do against the assessor. So similar to what we did in TRP, should we do first understand the concept and then we can revise the notes. Okay. When I say search, you remember the movie of Ajay Devgan, Raid, if you're from North India. So you all understand and from your childhood what the search is. And a car filled with officers and police officers come and they just raid your house, your office, your factory, your premises, and they just tear the bed sheets, bed covers, and opens the almirahs, make them empty, and they do all these things. So this is something what a search means. You have already studied the powers, how the search is conducted in your income tax authority chapter. So what the powers the search party has and everything. What we are doing now? We are doing in today's class is what will happen, what happens once a search is conducted in the place of assessing. So, how the assessment is done in such cases. Okay. First, understand what I mean by search. So, in income tax, a search means three things. One, the search which you understand that the tax officers come to your house and they search your premises. It may happen, my dear friends, that income tax officer doesn't come to your house, but the ED, the CBI, or any other, the GST officer may did the search in your house and they seize the documents. Income tax officer say, sir, I also want to search the assessee. But the GST officer say, okay, go search. But sir, what will I search? You have seized everything. The house is empty. What will I do there? So, what should I do? The GST officer says. The income tax officer says, sir, please, give me the documents which you seized from the assessee. I'll also raise the income tax demand. The GST officer says, wait, let me complete. Once I'll complete my work, I'll give the documents to you. Okay. So, what happens in this case? The income tax officer, income tax department requisitions the document from any other authority who has seized them. So, requisition. Though income tax officers have not physically searched the assessee, is some other officer. But if the income tax officer has got the documents from such other authority, then it is deemed that the search has happened under the income tax as well. So in this case also a case of search. You understand the difference? In first case, the income tax officer physically searched the premises. In the second case, income tax officer didn't search, but he got the document or other information, other assets from the another government authority who had searched the assessee. There is one more thing. See, income tax officer visited a premises and searched it in the case of assessing. There he found there is a car or there is a diamond necklace or there are some investment shares which are lying there, but they are not of the assessee. They doesn't belong to the assessee. They belong to the brother of assessee. So he seized those documents as well. And what he will do? He will hand over those documents to the officer, tax officer, who has jurisdiction over the brother of the assessee. Because only the jurisdictional officer can act. So what this tax officer does it? He seized the document, whatever he found from the place of the assessee, and in case of after scrutiny, he found that these documents does not pertain to the assessee. That pertain to the brother of assessee. So he handed over such document to the assessing officer who have jurisdiction over the brother of assessing. And in this case, it will be deemed that a search has happened on the brother of assessee as well, or other person. So practically what happens is that practically a search happens in the premises of a builder. Yeah? There, the tax officer finds that there are many people who have give cash to the builder for the purchase of the house or land, and such cash. So he got the information about the other person as well, other than the assessee, other than the builder, and he passed on this information to the assessing office of such other person, and the assessment in case of such other person happens as if a search has happened in the premises of such other person. You understood? So in case of first, this actual physical search has happened in the premises of the assessee by the income tax officer. In case of 2 and 3, the income tax officer has not physically searched the Miss Gita, is there any question? I just saw one new, but I could not see. Let me know if there's any question, Gita ma'am. So, in the first case, the income tax officer has physically searched the premises of the assessee. But in second and third case, he has not physically searched the assessee. What he has done? In second case, he has got the documents and information from another officer. Or in the third case, he got it in the course of search of some other person. In all these three cases, it's deemed that search has happened. Okay? You are with me? It's very important to get the concepts clear. Okay? Now, in such cases, what happens is that what the law says, if the search has undertaken place on or after 1st September 24, then the assessment in such case has to be had in a like block assessment. So, what we say? What is block assessment? You could understand the meaning. Block assessment means a assessment of a block of years, a multiple years is happening in one go, a lump sum assessment. Okay. So yes. So in this case, when a search has happened, all the above three cases, a block assessment happens. The assessment for multiple years happens at a time. In those days, singly. So it's not that for every year there is separate assessment. One assessment happens for multiple years. So what are those multiple years? Very important. Very, very important. Just focus on me. Okay. So law says in case of search, you have to identify block period. What is block period? What you have to identify? Block period. So what is block period? It says you noted down 2 days. One date is when the search is initiated. Assuming the search initiated on 29th of June 25. Okay. And this is initiation. Starting. And second date when the search is concluded. Assuming it's concluded on 2nd of July 25th. Concluded. Sir, how can it happen that search runs for more than a day? Will the tax officer stay in the home of the assessee? Yes. Government officer work more than 24 hours. So it happens normally search runs for more than a day. In this case, it runs for 29, 30, 1 and 2, 4 days. So it started on 29th June and it concluded on 2nd of July. If you are from North India, you read from Ajay Devgan. It's very much related. Okay. So it started from on 29th June and concluded on 2nd of July. The day on which the search is concluded, we called it date of execution of last authorization. Okay, thanks, Mama. So what's the block period? The law says block period means the period you identify the year in which search take place. So search took in previous year 25-26. You're with me? The block period means the period of 6 years immediately preceding the previous year in which search was initiated. So search was initiated in previous year 25-26. So the block period in my case would be 24, 25, 23, 24, 22, 23, 21, 22, 20, 21, and 19, 20. So this is 6 years is a part of a block period. It's not ended. Plus, the current year in which the search has happened, but not the complete year. Plus the current year means the first period starting from 1st Apply 25 up to the date of conclusion of search. In our case, 2nd July 25. So these complete periods, the 6 complete year and partly current year, forms part of the block period. So understood block period? What's block period? 6 year plus the current year, only up to the date of conclusion of search. Go with me? So block period means a period of 6 years plus current year up to a date of conclusion of search. An assessment of all this period has to be done if in case of search. Am I clear? Any doubt? Let me know. We are going slowly so that you can absorb. Another thing which you need to remember is, so the definition of undisclosed income. So what is it? See, we are not memorizing definition, we are understanding it. You understood the meaning of block period? It's the period of 6 years immediately preceding the previous year in which search has happened, plus period starting from 1st Apply to the date of conclusion of search in case of the current year. Okay. I told you in exams you are not required to write the language of the act, but whatever you require should give the same meaning what the provision has. Okay. So secondly, undisclosed income. What is the undisclosed income? Come in the notes. Undisclosed income means any money, bullion, jewelry, valuable article, virtual digital assets, or any expenditure or any income which is not disclosed. So if during the search, the assessing of the search party finds that there you have the assessee has a land in Pune, 100 acre of land in Pune, which is not disclosed in the income tax filing, then this is undisclosed income. If there is some income, if assessee has a business in Bombay and Pune, and assessee has not shown the Pune business in income tax return, then it is Mr. Sanjay is asking that so for 6 previous year reassessment is done in case of search. Is that right? So yes, for 6 previous years there would be assessment, but that assessment is called block assessment. We don't call it reassessment. So that block assessment may happen whether the assessments already been happened in respect of those 6 years, or it may happen whether the assessment has not been happened in respect of those 6 years. So whether assessment has already been done under other provisions for those 6 years or not is not relevant. Whether it has done or whether it has not done, block assessment, for the block assessment, all these 6 years has to be assessed again. Okay. Vagita is asking, is it section 68 to 69D? See, we are talking about the assessment, Gita ma'am. Section 68 to 69D is related to undisclosed. Right? I think you're asking this in respect of undisclosed income. So this is very much similar to undisclosed, but the definition of undisclosed income is given in chapter 14B, which we are doing, the search. What section 68 to 69D says, it's very much related, but they say if assessee is found to be the owner of any asset which is not disclosed, such assets shall be deemed to be the income of the assessee. So what will happen? I can find undisclosed income and can invoke section 68 to tax that. Okay, but the assessment shall be done under chapter 14b. I hope it makes sense. So, and if you see in this case, undisclosed income, whether the undisclosed income is on account of the assets or the expenditure or the income, all are considered in one section. But if you see the section 68 to 69D, there is separate section for all this. There is separate section for the assets, separate section for the expenditure, separate section for the cash credit and everything. Okay. So let's come back. The undisclosed income means if the asset tax officer finds some assets during the course of search, then which is not disclosed, then this is undisclosed. If tax officer finds some income, if it finds there's some business in Nagpur which is not disclosed, then such income is undisclosed. If a tax officer found some expenditure which is not disclosed, then it's also an undisclosed income. How can an expenditure be an income? Of course, see, if there's an expenditure which has been incurred by the assessee, then which is not disclosed, then assessee must have got the money for incurring such expenditure from somewhere, and such money should have been reported as an income. So assessee neither report that income nor expenditure. The assessee incurred an expenditure of say rupees 5 crore on the marriage of his daughter, and this 5 crore is undisclosed. So once an assessee incurred 5 crore, he must have earned it as well and had not offered for the income tax, and therefore expenditure can also result in an undisclosed income. On which basis AO do previous 6 years block assessment? So if there is a search, then AO has to do the 6-year block assessment, the law says. So the basis is the search. The search has happened in the premises of assessee, then the AO is mandatorily required to do the assessment for the block period of 6 years. Understood? So this is undisclosed income. Undisclosed income includes one more thing. If there is any expenditure which is recorded in the books of account, but the expenditure is false. And this expenditure is also forms part of undisclosed income. So what all forms part of undisclosed income? The assets which the assessee has not disclosed, the income which the assessee has not disclosed, the expenditure which the assessee has not disclosed, the expenditure which the assessee has recorded in the books of account but which is not genuine, which is bogus. Okay. So till now, let's study what we have discussed. So definition: block period. The period comprising previous year relevant to 6 assessment year preceding the previous year in which the search was initiated. Understood? From 1920 to 24-25 in our example. Or any requisition was made. You understand the meaning of requisition. In the entire topic today, in the entire chapter, wherever I will use the word search, it means the requisition as well. It also includes what? The block period also includes the period starting from 1st April of the previous year in which search was initiated or requisition was made and ending on the date of execution of last of the authorization. What is this? Execution of last of the authorization is the date on which the search has been concluded. Ending on the date of the execution of last of the authorization for such search or such requisition. You understood the meaning of block period? The 6 previous year immediately preceding the previous year when search is conducted, and the current year starting from 1st April up to the date of completion of search. In case of requisition under section 132A, where the books of account assets are requisitioned from any other authority, the last of authorization shall be deemed to have been executed on the actual receipt of books of account or other document or asset by the authorized officer. Okay. Secondly, undisclosed income. It includes any money, bullion, jewelry, virtual digital asset, Bitcoin, etc., or other valuable article or thing, or any expenditure minded, or any income based on any entry in books of account or other document or transaction where such money, bullion, jewelry, virtual digital asset, valuable article or thing, or entry in the books of account or other document or transaction. So what is meant by last of the authorization? See, what happens is that in case of such, panchnamas are issued. By way of panchnama, the tax officer says what he wants to say. So when the last panchnama was issued is the date when the search is deemed to have been concluded. Okay. So meaning of last of the authorization means the last panchnama was issued. The date on the last panchnama was issued is the date when the search is actually concluded. So what I was saying that undisclosed income means include money, bullion, jewelry, which has not been or would not have been disclosed for the purpose of this act. It includes expenditure based on any entry in the books of account or other documents which has not been disclosed for the purpose of this act. It includes any income based on any entry in the books of account or other document which has not been disclosed for the purpose of this act. Understood? So if there's any asset or expenditure or income which has not been disclosed, shall form part of undisclosed income. Then it also includes expense, exemption, deduction, allowance claimed under the Act. It is found to be incorrect in respect of block period. If the assessee has claimed any expenditure or deduction which is found to be incorrect, then that expenditure should also form parts of the undisclosed income. Very much logical. So till now, it's very much logical. Always look for the logic. Right? It will help you in retaining the things. Now, what happens when a search is happened? So once search is concluded, what the AO does, he goes to his office and issues a notice to assessee. What notice? The notice asks the assessee. The notice asks the assessee to furnish return of income. Okay. So what the notice does is, notice only asks the assessee to furnish return of income of the block period. Similar notice was issued in case of 147 as well. The notice in section 148. The notice was nothing. It only asked the assessee to furnish return of income. Similar here, the notice only asked the assessee to furnish return of income of the block period. So once the assessee furnish a return of income in pursuance of this notice, this return is called a return under section 139. So is there any time limit for the assessee to furnish the return of income? So there is no prescribed time limit. The assessee has to furnish the return of income by the time specified in the notice. So, but the AO can not give them more than 60 days. Okay. So AO issues a notice asking assessee to furnish return of income in the block period within a time specified in the notice. But the time cannot exceed 60 days. And if assessee furnish the return within the time specified in the notice, then the return is called return under section 139. Okay. But this return cannot be revised. It cannot be revised. Once the return is filed, it's filed. And it will not be processed as well. Yes. There is no need to process this return under section 143(1) because AO will anyway scrutinize the return in a very detailed manner. Okay, so there is no need to process this return. So what happens is that when the search is conducted, the AO shall issue a notice asking assessee to furnish return of income of the undisclosed income. So what's the assessee furnish a return of the undisclosed income? And such return cannot be revised, it cannot be processed. But if assessee does not furnish the return within the time specified, then he has to pay interest at the rate of 1.25%, I think. He has to pay the interest at the rate of 1.5%, sorry. So he has to pay the interest at the rate of 1.5% per month or part of the month. This is very similar to 234A. But there the rate was 1%. Here the rate is 1.5%. Okay. So what happens is that the procedure for block assessment. The AO shall issue notice to the person on whom search is conducted, a books of account or acquisition, requiring him to file within such period not exceeding period of 60 days. As may be specified in the notice, a return setting for this undisclosed income for the block period. So what will the AO do? AO will issue a notice asking assessee to furnish the return for undisclosed income. Okay. But before issuing such notice, the AO needs an approval of his senior officer. And who are senior officers? Either the additional or the joint. So prior approval of additional commissioner or additional director, or joint commissioner or joint director, as the case may be, shall be obtained before issuing a notice. So in the case of such, at the time of issue of notice, this notice, and also at the time of passing the assessment order, the AO will need the approval of these authorities, which is additional and joint, as the case may be. Such return is considered as a return of section 139. However, such return cannot be revised. Such return shall not be processed. Logical. Return furnished beyond the period allowed are not deemed to be returned under section 139. When the assessee fails to furnish the return within a specified time in the notice or does not file it at all, the assessee is liable to pay interest at the rate of 1.5% for each month or part of the month. In 234A, it was 1%, here it's 1.5%. In case of such, interest under section 234A is not levied, rather this interest is levied, which is 1.5% for every month or part of the month. On the amount of tax on the undisputed income, interest always levied on the amount of tax. So whatever tax is computed on the undisclosed income, on that tax, interest at 1.5% per month or part of the month is also levied if the assessee has not furnished the return within the time. The interest shall be charged for the period from the day immediately following the expiry of the time specified in the notice. Logical. Ending on the date of completion of block assessment. Understood? Okay. In this case, once assessment is being done under, in case of block assessment, notice in section 148 is not required to be issued. No notice in section 148 is required to be issued for the purpose of proceeding in this chapter. Okay. So lastly, the time allowed in the notice of furnishing return of income can be extended by 30 days. The time allowed for furnishing return under this clause may be extended for further period of 30 days. Where? See, assuming the search happens on, when the search happened? It happened on 29th June 25 and it concluded on 2nd July 25, right? In our example. Now, the block period also includes the period of financial year 24-25, right? So, for the financial year 24-25, on the date of initiation of search, assuming I am liable for tax audit, and the due date for furnishing tax audit report is 30th September, we all know. And on the date of initiation of search, which is 29th June, the tax audit has not yet been completed. Then on 29th of June, the tax audit has not been completed. Then the assessee may request the AO to give it another 30 days. So what says that the time allowed for furnishing return of income under this clause may be extended by further period of 30 days by AO, where the due date of furnished return of previous year immediately preceding the year in which search or requisition has not expired. So due date of furnishing return for 24-25 is 31st October. It has not expired. Before the date of initiation of search, the assessee was liable for audit for such previous year, and such audit has not been completed on the date of issuance of such notice. And the assessee requests in writing for an extension of time of furnishing such return so that he may get such account audited. In such case, AO may give another 30 days. But if AO gives another 30 days, then the period for completing the assessment which the AO has shall also be extended accordingly. In above case, the period to complete block assessment shall also be extended accordingly. Okay. So Geeta ma'am is asking, Miss Geeta is asking that assessee has already filed the return for previous year, then also assessee has to file return under section 139 again for all this year. Yes. So whether you have furnished the return or not for all this year, it's mandatory required to furnish the return in response to a notice issued by the A. Okay? Okay. So let's break for thank you. So let's break for 5 minutes and then again reassemble after 5 minutes and then we shall complete the this such assessment. Okay. Meanwhile, you can revise whatever I have studied, I have taught you, and ask the question if in case you have any question. Okay. So we'll wait. We will break. We have a break for 5 minutes. So welcome back. So all again fresh. We'll again start. Okay. So what we discuss? We discuss what happens when there is search or acquisition. Okay. So in such case, we have to first identify the block period, which is a period of 6 years plus the current year partly. Then we discuss the meaning of undisclosed income. Understood? Then we discuss what happens is that when the search happens, the AO issues notice asking assessee to furnish the return of income. Okay. For the block period. Now Sanjay ji is asking that what is the purpose of filing the ITR again? So see, the situation has differed. Earlier, the assessee may have concealed something, but now the assessee knows that the department know that there is an income. So such has already happened. So assessee knows that department has found out there are some undisclosed asset, undisclosed income. So he may want to disclose it. So by asking the assessee to furnish return of income, the department is giving another opportunity to the assessee to disclose his undisclosed income. See, the search has already happened. Department has all the record. Department can compute the undisclosed income. But before doing that, another opportunity is being given to the assessee to come clean, to show the undisclosed income which you have not shown earlier. What's the difference? See, now there are two types of undisclosed income. One, this undisclosed income is the one which the assessee has shown in the return. See, this is also undisclosed. If the assessee has shown some additional income in the return filed in pursuance to this notice, in the case of search, then this is undisclosed income. Why? Because had the search not happened to you, then you would not have disclosed this. Of course, you have disclosed this only after the search has been undertaken. So this is also undisclosed. But there are two types of undisclosed income. One which has been disclosed in this return, and one which you have not disclosed even in the return, and which the AO has found out and he will add in the assessment order. You understood? Both are undisclosed. Why the first one is undisclosed? Because you have disclosed it only after the search. Had the search not been taken place in your premises, you would not have been disclosed it. This is one. Secondly, there may be a return which may be an income which you have not disclosed even in the return, in this new return. That is the income which the AO has found out. So, if in your opinion, in which case there should be the more tax liability? Of course, in the case of second one, there would be a higher liability in the case of first as well. But in the second one is a more severe thing. You have not disclosed even when you are allowed another opportunity. So, what happens is that both this income is generally taxed at the rate of 60%. But in case of second type of income, a penalty is also levied at the rate of 50%. So I hope Sanjay ji, you got the answer. So generally, the return which the assessee has earlier filed for this year and the return which the assessee is not filing for this 6 years differs. Okay, but whether it differs or whether it doesn't differ, he has to file. But you understood why the law is asking the assessee to furnish a return of income? It's giving another opportunity. The same logic applies in case of income escaping assessment, which we did in the last class. In such case as well, the notice under section 148 asks the assessee to furnish return of income, even if the income for such year has already been furnished. So in both the cases, the first notice only asks for the return of income, so that it's another opportunity given to the assessee to come clean. Okay. Okay. So we have understood the meaning of undisclosed income, and we have also done the section 158 PC, where the AO issues the notice for asking assessee to furnish return of income. Okay. Now let's do some small concept. See, what happened is that in our case, the 6 years were from financial year 2019, 2022, 2024, 25. Now it may happen that for some assessment year, for some of these years, the assessments may be pending assessment under other section, section 143.3, 144, or maybe it may be pending on in respect of some of these years. It may happen that for assessment year, for previous year 22, 23, an assessment may be pending in section 147. For 24, 25, an assessment may be pending under section 143.3. It may happen. So what the law says that block assessment is a bigger brother. It says once I come, everybody has to leave. I'll do this. I'll drive. So what it says, when a search happens, to whatever assessment which are pending on the date of initiation of search. In our case, initiation of search. In our case, it was 29th June 25. So whatever assessment which were pending as on this date shall abate. Abate means shall stop. They shall not continue. Okay. So now all these years shall be assessed as a part of block assessment. If any assessment are pending on this date, on which date? On the date of initiation of search, then they shall abate. So AO shall not proceed in these proceedings, on those assessment proceedings. Those proceedings shall abate on the date of initiation of search. Now those years will be assessed as part of block assessment. Make sense? Make sense? Okay. But remember, what the law says is that assessment shall abate. It may happen that for the financial year 1920, assessment may have been completed. Assessment had already been completed and the case is pending before CIT appeal. Then the appeal or revision proceeding shall not abate. When the assessment proceeding shall abate. You're with me? Okay. Okay, good. But it may happen. See, a search happened on 29th June and it makes, what is the consequence? The assessment proceeding which were pending as on this date abated. But what I did is, as an assessee, I went to the High Court and challenged the search itself. I challenged that the proceeding of search is not valid. Either you did not have the authorization or whatever reason, for any legal ground or technical ground or factual ground, I challenged that such proceedings are not valid. And High Court accepted it. And it quashed the entire search. So block assessment quashed. Whatever had happened had quashed. Okay. So department is at fix. What will he do? But then government say, okay. My block assessment has quashed, my search proceeding has quashed, but now I will revive my abated assessment. The assessment which were abated on account of search. Because search had happened, therefore you have abated my assessments which were earlier continuing for the year, I think 21, 22 or 23, 24, whatever. So whatever years the assessment which was there, which were pending as on date of initiation of search, had abated. But now, since the search has been held to be illegal, has been quashed, the entire search proceeding has been quashed. Now this abated assessment shall revive, and now I will do the normal. The assessment, I will continue with this assessment. It makes sense? So, if there is block assessment, then all the assessment shall abate. But if the block assessment is annulled means is cancelled by some authority, by some court, then the assessment which had abated shall not revive. But it may happen that the High Court had annulled the search, but the department filed an appeal to the Supreme Court, and Supreme Court said that the search was rightly done. There was no non-compliance. The search was as per the law, and it again revived the search. What would happen in such case? Then the assessment which had been revived now will again get abated. Okay. The thing is very simple. There would either be the block assessment or the assessment under any other provision of that. both cannot go together. So if such has happened, then the assessment proceeding shall abate and block assessment shall happen. But if court annul the search, then block assessment shall quash and normal proceedings which had abated shall revive. But subsequently, if such order of annulment has been cancelled, meaning thereby the search has been held to be valid, then again the normal assessments in other section shall be abated and the assessment shall be done in the as a block assessment. You with me? So the moral of the story: either the assessment under other provisions or the block assessment. In no case both will go. But in every case, either one of them will go. If the block assessment abate, revive. Actually, so it's not that once it's abated for the lifetime. If the search has had to be invalid, then this abated assessment shall revive. You with me? Okay. See, there may be a situation that a search happened on 29th June, 25, concluded on 2nd July, right? 25. Now, there may be a situation that, say, on 29th September 25, another search happened on the same processing and it concluded on 30th September. They may happen. Another search may happen. Then, for this search, AO has to do the block assessment. But this block assessment must be pending on the date of initiation of this search. Second search. Here also, AO is required to do the block assessment for the second search. Now, what do you think? Whether on the date of initiation of this search on 29 June, whether this block assessment which was pending, whether it shall abate? So answer is no. What the law says? It says the assessment under any other provisions, under any other chapter shall abate, not the assessment, block assessment. What happens in this case is that for the doing the block assessment for the second search, the AO has to first complete the block assessment for the first search. Once it's completed, then he will start proceeding for the block assessment of the second search. Understood? So, block assessment, the big brother shall give way to his big brother. So, if there is a block assessment already undergoing, it will complete, and only after its completion, the block assessment of another search which had happened shall start. Okay, you're with me? Okay, sir. So now we are on the very important thing. So we have till now what we have already discussed. We have discussed what's the block period. You understand? We have discussed the undisclosed income. Okay. We have discussed how the assessment is done in the case of search. What happens is that the AO issues a notice asking assessee to furnish return of income. Once the assessee furnish return of income, then what happens? Then similar thing. The AO issues notice asking for the information. Assessee submits reply. AO again issue notice. Assessee again submits reply. And finally, the AO determines the undisclosed income on which tax has to be levied. So I told you the tax which is levied on undisclosed income is the 60%. In case of search, the tax is levied at the rate of 60%. Okay. Now, 60% of what? Of what? On what amount this 60% shall be levied? Of course, 60% on the undisclosed income. So what the law says, see. The total undisclosed income of block period shall be aggregate of the following. What? Undisclosed income declared in the return. You got, Sanjay ji, you asked that while the return is filed. So whatever undisclosed income you have furnished in the return of income shall form part of the undisclosed income on which 60% shall be applied. So total undisclosed income means the undisclosed income which the assessee has furnished in the return under section 158 BC plus. So Geeta ma'am is asking whether surcharge and cess shall also apply. on this 60%. See, there is not a big clarity on whether such shall apply or not. The ICAI module said it shall apply. So we'll go with the whatever the ICAI says, it shall apply. Okay. So undisclosed income means the income which you disclose in the return furnished under section 158 BC in pursuance to a search, and undisclosed and the income determined by the AO on the basis of evidence found as a result of search or survey or acquisition or information as a either available with the AO or come to his notice during the course of proceeding in this chapter. So the income which has been disclosed by the assessee in the return plus whatever income which the AO has found out, AO has gathered, yeah, which we have discussed. The aggregate of this is the undisclosed income on which 60% tax is applied. Okay. The important part is following income shall not be included in undisclosed income. The income which is referred here, it's not part of undisclosed income. What is this? Very, very logical. Okay. What would not be the undisclosed income? I tell you. The income which I have already disclosed in the return furnished under section 139. I had furnished the return for all these years earlier, and in those return I have disclosed the income. Those return were furnished before the search, so that's what genuine disclosure, honest disclosure. So the income which I have disclosed in the return for all these years, which was filed under section 139, should not form part of undisclosed income. I should not be paying higher tax on this income because there is no concealment for this. You are with me? Secondly, friends, if the assessment has already been done in respect of these years, then whatever income has been assessed has not been concealed. It has already been assessed. I have already paid tax, interest, penalty, whatever as per the relevant provisions of such assessment. So, income already assessed. This should not be form part of my undisclosed income. Logical? You are with me? Third, innovative. There may be a case assuming a foreign company is earning a royalty from India and the Indian party deducts a TDS under section 115A. Now, in such case, the foreign company is not required to furnish return of income. Okay, it's legally not required to furnish return of income. Okay. Now, if you say that you have not furnished return of income, quasi royalty income you receive from India, and therefore I will treat it as undisclosed income, that's not fair. I would have, of course, furnished the return of income had I was required. The law only allows me to not to furnish the return of income. Okay, because the tax has already been deducted. So the income in respect of which TDS has been deducted and the law exempts the assessee to furnish return of income, then such income should not be considered as the undisclosed income. It's as good as the returned income. You're with me? Understood now? Here I furnish the return of income because I was required to. If an assessee is not required to furnish return of income, the law exempts the assessee from furnishing return of income because the tax has been deducted in his case. Then if I have not furnished return of income, then I should not be penalized because law allows me. So if return not furnished but TDS deducted, return not furnished but tax deducted, even this income should not form part of undisclosed income because there is no concealment here also. Very logical. Keep the logic alive. It will help you in retaining the things. Fourth, see, in our case, the search happened in the financial year 25-26. So for the financial year 24-25, though I have not filed the return of income, why? Because the due date was still there. On the date of initiation of search, I still had a time to furnish return of income. How on earth would I come to know that you are going to search me? Should I file the return of income before that? Search is always a surprise. Always. So, how can you say that I will not have disclosed the income for FY 24-25? So, for the financial year 24-25, if there was a time to furnish return of income and I have recorded the transactions in books of account, all the transactions are recorded. Then for income relating to such transactions which are already recorded, so there is no intent of concealment, should not form part of undisclosed income. You're with me? I have not filed return of income because I have a time to file return of income and I have recorded everything. Whatever you have found in the search, I have recorded everything in my books of account. So this basic assumption that I will report it also. Okay. Then for the current year, it divides the current in two parts. In our case, from 1st April 25 to 29th June 25. Even for this period, if the transaction is recorded in the books of account, then you cannot say that income for this period is undisclosed to the extent the transactions are recorded in the books of account. Because how would I report? I will report only to the return, and the return will file once the time limit is there, once the year has closed, and I will file the return. So if I recorded the transaction books of account, then there is basic presumption that I will offer such income to tax as well in the return of income. So for this period, if the transaction recorded in the books of account, then it's deemed it's not part of undisclosed income. Also, for the period from 29 June to 2nd July, period during which search continues. If I am recording this transaction in my books of account, then for this as well, you cannot say that this is undisclosed income. Very much logic. So whatever income I have already offered, or there's a reasonable, there's a logical assumption that I would have offered had the time had come, then all those income is not part of undisclosed income. Let's see. Now you will read, it will help you. It will be easy for you. So it says following income shall not be included in the total undisclosed income of the block period. What shall not be included? Total income determined in section 143(1) or already assessed prior to the date of initiation of search or date of acquisition in respect of any year comprising the block period. Okay, so return determined under section 143(1) or already assessed, or total income declared in the return of income filed in section 139 or in response to notice in section 142(1) prior to the date of initiation of search or date of acquisition. If I already furnished the return before the date of search, then I have already disclosed it. It should not form part of undisclosed income. No concealment. In respect of any of the previous year comprising in the block period and not covered in A above. Understood? The total income computed under the provision where return filing is not mandatory and tax on such income is paid by way of TDS. So the law allows the assessee to not to furnish a return of income if tax has been deducted. And accordingly, assessee does not furnish a return of income. And therefore, if tax has been deducted, then this income should also not form part of undisclosed income. I hope you are with me. The income computed by assessee in respect of a previous year where due date for furnishing return of for such year has not expired, 24-25, prior to the date of initiation of search, on the basis of entries relating to such income as recorded in the books of account maintained in the normal course before the date of initiation of search. If I have maintained everything, if I have recorded every transaction in my books of account, and the time limit is still there to furnish a return of income, then it should be presumed that I will offer it, I will disclose it in the return of income. It should not form part of undisclosed income. I hope you are with me. The period from 1st April of the previous year in which search is initiated or acquisition made and ending on the day immediately preceding the date of initiation of search. In our case, 1st April 25 to 28th June 25, because search initiated on 29th June. On the basis of entries relating to such income as recorded in the books of account maintained the normal course of such period on or before the day immediately preceding date of initiation of search. The period commencing from the date of initiation of search, 29 June, period starting from 29 June, and ending on the date of execution of last of the authorization of search, 22nd July. You understood? Last of the authorization means the date of conclusion. On the basis of entry relating to such income as recorded in the books of account maintained in normal course for such period on or before the date of execution of last authorization. So even if I have not furnished a return of income, but I have recorded everything and there was a time to furnish return of income, then it will be deemed that I would have offered, and all this income shall not form part of undisclosed income. What's the undisclosed income? Undisclosed income is the income which I have disclosed in the return furnished under section 158 BC, furnished in pursuance to a notice issued under such assessment, plus undisclosed income which I have not even offered in the return and which the AO has found out and had included in the order. Okay, so you're with me? Okay, one more thing. What the law says, assuming, see, my block period is from 2019 to starting from 2019. Assuming for financial year 2018-19, financial 18-19, there was a loss under the head PGBP of rupees 10 crore, which I carried forward for 1920. Now for this 6 years, 2019 to 24-25, the question comes, can I set off this loss in these 6 years? Once search has taken place, this loss, the earlier loss, cannot be set off against the block period. But you can set it off subsequent to the block period, but within the time limit, within the 8 years. And for computing 8 years, this block period shall not be excluded. It shall not be excluded. So 6 years has already been gone, has already been wasted in the block period. Whatever time left after the block period, you can set up the loss. Loss brought from previous year prior to the first previous year comprising in the block period or unabsorbed depreciation under section 32(2) shall not be set off against the undisclosed income determined in the block assessment under this chapter. Shall not be set off. However, it may be carried forward for being set off in the previous year subsequent to the assessment year in which block period ends for the remaining period. Got the point? For the remaining period. Taking into account the block period, such assessment year and in accordance with the provision of this chapter. So very dangerous provision. Very dangerous. Okay, one more thing. It says that for the current year, 25-26, or I would say 1st April 25 till 29th June, or rather 2nd July 25. This is also part of block period. If any transaction is found which relates to the computation of arms and price, means any TP transaction or specified domestic transaction is found during this period, then this transaction is not part of block assessment. It will be assessed separately when the assessment for this year is done. It's not that they will leave you. For this transaction, they have created an exception and they will be taxed, they will be assessed separately for the when the assessment for the current year is happened, not as part of block period. So it says, where any income required to be determined as a result of search or accusation relates to any international transaction, CT, or specified domestic transaction, SDT, referred to in section 92 CA, pertaining to the period beginning from 1st April of the previous year in which last okay, so Sanjay is asking, is it only 18-19 laws only which cannot be set off? It could be even 17-18 numbers of laws. So whatever laws which was there, which you carried forward as on 1st April 19, first day of the start of the block period. In our example, understood? So whatever laws it was there as on 1st April 19, it cannot be set off against the block assessment. It will be set off after the completion of the block assessment. So period subsequent to the block period. Okay. So it says where any income required to be determined as a result of search relates to international transaction or SDT. Pertaining to which period? Period from the 1st April of the previous year in which last of the authorization was executed and ending with the date on which last of the authorization was executed. In our example, 1st April 25 to 2nd July 25. So, if during this period there is any transaction related to TP or SGT, such income shall not be considered for the purpose of determining total undisclosed income of the block period. Such income shall be considered in the assessment made under other provision of the Act. So, if there is an assessment for the current year and other provision, then such income shall be considered, but shall not be considered in the such case. Okay. Small point. In case of firm, it says while computing undisclosed income, no deduction shall be allowed in respect of any amount paid to non-working party. See, if a such happen in the case of a firm, partnership firm, then if firm is paying anything to the non-working party, then such amount shall not be allowed while computing the undisclosed income. If you remember, there is section 40B under the head EGBT. It allows interest paid to the non-working partner. What it says that interest paid to any partner is allowed subject to the rate of 12%. It disallows the salary paid to the non-working partner. If any salary is paid to the non-working partner, disallow. You with me? But in case of search, any amount paid to the non-working partner is disallowed, whether it's interest or salary. That is anyway disallowed. But even the interest payment to the non-working partner is disallowed. So it says, in case of firm, no deduction shall be allowed in respect of any salary, interest, commission, bonus, emulation by whatever name called paid to non-working partner. So even interest shall not be allowed. You with me? Okay. So we have done major part of search. You understood what happened in search? See, two things is important. One thing, the procedure, then the code. The code is the tax officer has to ascertain the undisclosed income of the block period. So this undisclosed income is the income which the assessee has reported in the return furnished under section 158 BC plus the income which the AO has found out. The aggregate of this is called undisclosed income. Now this undisclosed income is taxed at the rate of 60% plus penalties. Okay. So, in such case, the AO or CITF may direct that assessee shall pay by way of penalty a sum equal to 50% of the tax so levied in respect of undisclosed income determined by AO under section 158 BC. So, first there is a tax of 60%, then there is a tax of 50% of the tax amount, which comes to 30%. So 90% of the income is gone if a search has happened. So almost entire income has been taken away by the department. The assessee does all the hard work while, but if you concede, if you doesn't pay the tax, then I'll not take the tax, I'll take the income. This is what the department says, the tax law says. Practically, they have taken the entire income. They have not taken the 30% of the tax. They have taken the entire income. You understood how? 60% the tax rate and 30% the penalty amount. 30% penalty amount is 50% of the tax. So it comes to 30%. It's the income. So in such case, AOCATP may direct the assessee shall pay by a penalty sum equal to 50% of the tax so levied in respect of undisclosed income. Now see, no order imposing penalty shall be made if such person furnished the return, the tax payable on the basis of such return has been paid, the tax on the income which you have disclosed in the return, or if assets seized consist of money, the assessee offers money so seized to be adjusted against the tax. If there was a money which was seized during the course of search, assessee say, you already have the money, adjusted against my tax liability. So it's equivalent. Evidence of tax paid is furnished along with the return, and an appeal is not filed against the assessment of that part of income which is shown in the return. So, if the assessee has shown some undisclosed income in the return, then the penalty on such undisclosed income shall not be levied if he has paid the tax and he has not filed the appeal against such part of undisclosed income. However, no immunity shall be available where the undisclosed income determined by the AO is in excess of the income shown in the return. In such case, the penalty shall be imposed on that portion of undisclosed income determined which is in excess of the amount shown in the return. So what it's saying the same thing which we just discussed. Assessee shows the undisclosed income of say 20 crore in the return of income for the entire block period. But AO assessed the assessee on rupees 30 crore in the assessment order for the entire block period. So this 30 crore consists two parts. 20 crore already disclosed in the return furnished under section 158 BC and 10 crore additional which AO found out. So tax would be levied on 30 crore, 60%. But penalty would be levied only on 10 crore. If assessee has disclosed in the return, has paid the tax, and has not filed the appeal qua this 20 crore, then penalty shall be levied only in respect of undisclosed income in excess of the income shown in the return. Okay? Sorry. Understood? Then, no order imposing penalty shall be made unless an assessee has been given a reasonable opportunity of being heard. Very much given. You already know. No order shall be made by the DCIT, Deputy or the Assistant Commissioner where the amount of penalty exceeds 2 lakh except with the approval of additional or joint. Okay. No interest under section 234A, B, C or penalty under section 278 shall be levied or imposed upon the assessee in respect of undisclosed income, assess or reassess. So these are normal provisions of interest and penalty. They are not applicable in case of such. In case of such, the penalty and interest are provided under the chapter 14B. Okay. Now, we are left with just a small two topics. First topic is other persons. You remember, we discussed the case of a builder, brother of assessee, whose document or asset were found in the premises of the assessee where a search had happened. Okay. So, what we said that in case of other person as well, it's deemed that a search has happened at his premises and therefore, even his case shall be assessed as part of block assessment. Okay. What says that? Where AO is satisfied that any asset seized or acquisition belongs to, or any books of account or documents seized or acquisition pertain to, or any information contained therein relates to a person other than a person with respect to whom search was made. So what I said that in the search was made in the premises of a builder, but there they found that Mr. A has paid rupees 1 crore in cash to book a house. So this information pertains to Mr. A. Then such books of account or document or assets shall be handed over to AO having jurisdiction over Mr. A. Okay. Case. And the block period for Mr. A shall be where there is only one specified person, where the search has happened only in case of builder, same as that of specified person. So whatever block period we computed for the builder, the same block period shall be applicable for Mr. A, whose document or asset has been found in the premises of the person who has been searched. Okay. Where there is more than one specified person, so block period shall be the later period of all the specified person. Same as that for specified person in whose case the block period ends on a later date. Okay. So say AO shall proceed under section 158 BC against such other person and provision of this chapter shall apply accordingly. You with me? We discuss this. Now, I told you for passing the assessment order for the block assessment, the AO needs an approval of additional or joint, as the case may be. So, for two things, he needs an approval. First, at the time of issue of notice, asking the return, and at the time of passing order. So, the order of assessment for block period shall be passed by AO not below the rank of deputy or assistant, as the case may be, with the previous approval of additional or joint. Okay. Now, time limit. So, what says that? Order under section 158 BC, the assessment order, shall be passed within 12 months from the end of the quarter. So tax laws are quite complex. Somewhere it use end of the financial year, somewhere ends of the month, somewhere ends of the quarter. 12 months from the end of the quarter in which last of the authorization for search or acquisition was executed made, as the case may be. So in our case, the last of the authorization was made on 2nd July 25. Now the order has to be passed. You end this quarter. The quarter ends on 30th September, July, August, September, and 12 months from 30th September 25 means 30th September 26. The AO has to pass the order of block assessment. But in case of any other person, Mr. A, order shall be passed 12 months from the end of the quarter in which notice under section 158 BC in pursuance to a section 158 BD. Notice means notice to ask for the return was issued to such other person. You are with me? Okay. Sanjay ji is smiling by their law is complex. It's complex, that's why we are being asked. There's a work for us. You know? And anybody can do the easy things. It's or the achievement is to the difficult thing. Of course, like earlier, if the case is referred to TPO, then the period shall be extended by 1 year, 12 months. And whatever exclusion was there in section 153, which we studied in the last class, the exclusion similar to if the proceeding had been stayed or the AO has referred to special audit. Yes, we can refer to special audit in case of such as well, or whatever there. So whatever time wasted during all this case shall be excluded. Okay. So my dear friends, this completes the search assessment. I hope you got the point. If there's any doubt, to let me know. I have one doubt. See, what I told you, the search started on 29 June 25th and ended on 2nd July 25th, right? Then another search started somewhere in 29th September, I think, 25th, and 30th September 25th it ended. I know the time limit to complete the assessment case of this search, first search, is 30th September 26th. Right? We just discussed. I want to know the time limit to complete assessment in this case. Because you told me you only told me, sir, the law says that the assessment for the second search shall start after the conclusion of the first assessment in the case of first search. So if I apply 12-month period, the period expires again on 30th September 26 because I will end this quarter, which is 30th September 25, and I will add 12 months, which comes to 30th September 26. If I start after 30th September 26, then how can I complete before 30th September 26? So, the law says, in case of subsequent search, where the period of completing the assessment with respect to subsequent search is less than 3 months, such period shall be extended to 3 months from the end of the month in which assessment with respect to earlier search was completed. So, you will end this period, it's 30 September, you will add 3 months. So, for this search, I will have a time till October, November, December. 31st December 26. Lot of timelines, but easy one. Okay. So, friends, this completes my search part. Assessment of search. I hope you understood. Now, the next important topic, very much relevant from practical point of view, is rectification of mistake. Okay. So, what happened is that the tax laws allows assessee as well as the tax officer, the authority, tax income tax authorities, to rectify any genuine mistake. So, firstly, it should be the mistake. What do you mean by mistake? Mistake means it should be very much apparent. 1 plus 1 equal to 3. This is mistake. 1 divided by 3 into 3 plus 1 minus 1 plus 3 is equal to 1. I don't know. I have to apply my mind. So, mistake should be very much apparent on the face. Well, this can be a mistake, but what the law says, if there are two views possible, then it's not a mistake. Or if it requires scrutiny of the facts or documents, then it's not a mistake. It should be very much apparent from record. I need not to verify more records. I have to scrutinize, or if there's something debatable, then it's not a mistake. Apparent from record. So only those mistakes which are apparent from record. You remember the word apparent from record. Mistakes which are apparent from record can be rectified under section 154. So a section which allows the assessee or the income tax authority to rectify a mistake. Which mistake? The mistake should be apparent from record. You with me? Okay. What you can rectify? You can rectify the order plus intimation. So generally you can only rectify the order, but the law allows you to rectify intimation. There are three types of intimation under the Act. One, 143(1), intimation for processing of return, which we have already studied. Then similar intimation is issued in case of TDS and TCS. So in case of TDS and TCS also, the assessee furnishes a return of income. Those returns, the assessee furnishes the TDS and TCS returns. Those returns are also processed, computerized, and intimation is issued. So all these three intimations plus the order can be rectified under section 154. But the rectification is limited to the mistake which is apparent from record. I hope things are clear. Apparent from record. Mistake which are apparent from record. So there should not be any debate, no argument. Everybody should say it's a mistake. No two views. Then it can be rectified. Assessee can also request for the rectification, or income tax authority may suo motu rectify. Who will rectify? The only one who has actually committed the mistake. So if the mistake is in the AO order, then AO shall rectify. How he can rectify? He can rectify on the application of assessee or suo motu. Suo motu means on its own, he can rectify. If mistake is in the order of CIT appeal, then who will rectify? CIT appeal. He can rectify on the request of assessee or suo motu on its own, or on the request of AO as well. Here AO can also find the mistake and he can request the CIT appeal to rectify. So if the mistake is apparent from record, the authority can rectify. If mistake is in the order of ITAT, then who will rectify? ITAT. No. Yes, means ITAT will rectify, but not under section 154. Because 154 applies to the income tax authorities and ITAT is not an authority. It will rectify in different section, later section to rectify the mistake in the ITAT order, but not in section 154. Understood? Okay. So what we can rectify? I can rectify an order or an intimation in respect of any mistake apparent from record. Now what all things qualify as a mistake apparent from record? The law says Supreme Court judgment, subsequent Supreme Court judgment qualifies a mistake apparent from record. So what happens is that assessee AO pass an order allowing expense A. Okay. Subsequently, the Supreme Court said that expense A was a depreciation on goodwill. Subsequently, the Supreme Court said that expense A is not allowed. Not allowed. Now, this Supreme Court judgment forms part of mistake apparent from record. Basis this judgment, though this judgment is passed in the case of any other assessee, But since this same expense, so basis the judgment, AO can rectify its assessment order. Suo moto. Of course, in this case, assessee shall not apply for the rectification because it's against the assessee. The expense is getting disallowed. So AO may suo moto rectify the order. The Supreme Court judgment, subsequent Supreme Court judgment forms part of mistake append form record. High Court judgment? No. High Court judgment doesn't form part of mistake append form record because it's not yet final. Okay. But if there is some retrospective amendment in the law, if the law has been changed from the earlier date, from the past date, then also it forms part of mistake append form record and order can be rectified. If the amendment is in favor of assessee, assessee shall apply. If the amendment is not in favor of assessee, then of course assessee will not apply. You would do the suo motu. Okay. See, 154 is for mistakes. It's not a review. It's not a review. If assessing officer has taken a position, qua 154, he cannot change the opinion. It's not a change of view, change of opinion. If the mistake on which no two views are possible, only that mistake can be rectified. Mistake can be mistake of fact or mistake of law. Any mistake of fact may be, say, AO says that rupees 1 CR was deposited in the bank account and was not explained. So I will take it as an income. But the bank statement clearly shows not 1 CR is 10 lakh. It's a mistake of fact. And mistake of law, any there's like a expense A it allowed and subsequently Supreme Court disallowed it. It's a mistake of law. So whether it's a mistake of fact or law is not relevant. The relevant part is the mistake should be apparent from record. No two views possible. This, okay. So what's the time limit for rectification? So yeah, it's not a perpetual thing. There's a time limit, and time limit is 4 years. 4 years from the end of financial year in which order sought to be rectified is passed. So whatever order you want to get rectified, you see the date of that order, you will end that financial year, and you will add 4 years from that date. So if the order was passed, say, 2nd Jan 2020. So the financial year ends on 31st March 2020, and this order can be rectified up to 31st March 24. 4 years from the end of the financial year in which order sought to be rectified is passed. You're with me? Okay. But there is no time limit to file an application. So once the time limit for passing an order is there, so application must be submitted before such date. But CBDT says that, one more thing. The law says if the assessee has made an application requesting for the rectification, then the rectification order should be passed within 6 months from the end of the month in which application is received. And this 6 months must be within this 4 years. So in this case, say the assessee makes an application on 1st Jan 24. In that case also, the AO should rectify the order by 31st March. Because 6 months cannot exceed this 4-year period. You understood? So the 4-year period is the ultimate timeline by which the rectification order should be passed. 4 years from the end of the financial year in which order sought to be amended is passed. Okay? But CBDT gives a relaxation that income tax authority can rectify the mistake even after 4 years. Even after 4 years. But only in which case? Only for the benefit of assessee. Only for the benefit of assessee, it can pass rectification order even after the 4 years. Okay. Now, one more thing. The order is rectified by passing another order, and such order is called rectification order. And since this is an order, rectification order, you can file an appeal against the rectification order itself. So say assessee files an application requesting for the rectification. and AO denied the rectification. So he will deny by passing rectification order. And assessee can file an appeal against this rectification order if he is aggrieved by the fact that AO has denied his rectification. Okay. Okay. Very interesting case came before the Supreme Court. What happened is that AO passed an order and he does two mistakes. Mistake A, mistake B in the order. Okay. Now, assessee files an application asking the AO to rectify only mistake A. Even assessee does not identify the mistake B. He only identifies mistake A and files an application requesting to the rectification. AO did the rectification and corrects the mistake A. Now, assuming this order was passed on 21st Jan 20, this rectification order is passed, say, on 2nd Jan 24, within 4-year period. Now, after 31st March 24, assessee finds out that there was another mistake B in the original assessment order. Now he wants to rectify the mistake B as well. But the problem is the 4-year period has already lapsed. The 4-year period lapsed on 31st March 2024. But what the court said that you will see the 4-year period not from the original order. You will see the 4-year period from the rectified order. Why? Because in the rectification order, the AO should have rectified all the mistakes which was there in the assessment order, even if not identified, not asked for by the assessee. Here, the assessee asked for correcting mistake A. AO has rectified mistake A. But the court said he should have suo motu rectified mistake B as well. Understood? And therefore, this subsequent rectification order, has a mistake apparent from record. What's the mistake? It has not rectified the what he ought to have rectified. And therefore, my 4-year period shall start from 2nd April 24, and I have time till 31st March 28 to rectify mistake B. You agree with me? Understood? Lastly, section 154 says that if the rectification is against the assessee, then it's mandatory that an opportunity of being heard is given to the assessee before the passing the rectification order. Principle of natural justice. I hope you're clear on this. Let's read the law. There's one small topic in this we'll discuss while reading the notes. Any income tax authority may amend any order passed by it or intimation under section 143(1), 200A or 206B, TDS and TCS to rectify any mistake apparent from record. You understand the meaning of apparent from record. So rectification can be any order or intimation or deemed intimation or TDS or TCS intimation. The rectification may be made by income tax authority on its own motion or on request of assessee or on request of AO if authority rectifying the mistake is commission appeal or joint commission appeal. An income tax authority may amend any order for any matter other than the matter which has been decided in appeal or revision. So this I was saying that we'll discuss. So what it says that, say in the assessment order, AO makes addition respect of expense A, B, C, D. Okay. Assessee files an appeal in respect of expense B, C, and D. Now, the law says even in this order, which has been appealed, there is a partial merger and the rectification can be made qua A. Meaning thereby, rectification can be made in respect of anything except B, C, D. So, only the matter which are pending before the appeal cannot be rectified by the IO. The appeal authority shall see them, whatever there is mistake or not. But any other matter which is not before the appellate authority can be rectified. Okay. So there is a doctrine of partial merger. An income tax authority may amend any order for any matter other than the matter which has been decided in any appeal. So the question is, what is the mode of request of rectification by assessee? Is there a form? So practically, So there are two ways to request for the rectification. There is no prescribed form. You file an application on A4 paper, simple application, and then the letter format. But even on the income tax portal, for some basic mistake like TDS credit and all, you can request online also. Or if the mistake is not covered in those income tax portal, those points which are covered in income tax portal, then you can file a letter with the AO as requesting him to rectify. And you have to in those letter, what would be the content of that letter? The letter would identify the mistake and it will try to prove that's a mistake apparent from record. Okay. So if you know the provision, you know how to deal with the income tax authorities. The assessee shall be given an opportunity of being heard before making any amendment which has the effect of increasing his liability or reducing a refund. It is called natural justice. Amendment shall be made by passing an order in writing. Further, if any sum is due to the assessee, a notice of demand shall be issued to him, and in case of refund, the same shall be granted to the assessee. No amendment shall be made after a period of 4 years from the end of financial year in which order sought to be amended was passed. Okay. If any application is made by assessee for rectification, the income tax authority shall pass the order within 6 months from the end of the month in which application is received, by it either making the amendment or refusing to allow the claim. So if an assessee requests for the rectification, then the order has to be passed within 6 months from the end of the month, whether making the rectification or rejecting the application as the case may be. The aforesaid time limit of 6 months cannot exceed the outer time limit of 4 years as referred above. So this 6 months is within the 4 years as we discussed. Okay, so this was my rectification. Now section 154. Now this section 155. This is automatic rectification. What do you mean by automatic rectification? So here some circumstances are stated where you will find there is a need of rectification. I'll explain you with the example. There is a section 50C, under the capital gain head. It says if the stamp duty value exceeds the sale consideration, then the stamp duty value is substituted for the sale consideration and capital gain is computed accordingly. Understood? There are some provisions, 10% leeway and all. Assuming the stamp duty value is 1 crore and the sale consideration is 80 lakh. Then, while computing capital gain, the sale consideration shall be considered as 1 crore. Okay. Now, what's the stamp duty value? Is the value on which the assessee has paid the stamp duty to the state government. And it might be a case that assessee might have challenged the stamp duty value before the state government. And subsequently, the state government may have agreed that the stamp duty value was only 80 lakh. Now, in such case, there should not be any addition. While computing capital gain, the sale consideration should have been considered as 80 lakh only and not the 1 crore. So, the capital gain which assessee computed by taking stamp duty value as sale consideration was wrong. Okay, it got rectified subsequently. But it may happen that the order of stamp duty value by the state government may come after the 4 years, may come after 10 years. Only after 10 years, it comes to know that the assessment which was made 10 years before was wrong. The basis on which the assessment was made, the stamp duty value, has changed, and therefore assessment should also change, and therefore assessee is eligible for refund. But how will it claim the refund? The period of 4 years already elapsed. This mistake has come only after the lapse of 4 years, and assessee is not mistaken. So law allows the automatic rectification in this case. In a way, it allows the extension of 4-year period in these cases. All these cases are very logical. We'll do one by one, you will understand. The only thing which we need to see is that whether from where the 4-year period shall be reckoned. From which date we will start counting 4-year period. Okay. So first is rectification of order of assessment of partner. Consequence of disallowance of remuneration in the hands of firm. If any remuneration is disallowed in the hands of the firm, then such amount of remuneration shall not be taxable in the hands of partner. So what does PGBP say? The partner is taxable only for the remuneration only to the extent of the amount allowed to the firm. If firm pays a remuneration of say rupees 1 lakh to the partner, and the allowance in respect of this remuneration in the hands of firm is only rupees 80,000, then only 80,000 taxable in the hands of the partner. This 20,000 is disallowed in the hands of firm, and firm is paying tax on this 20,000. Okay. But in the case of, say, assessment of the firm, subsequently, the disallowance exceeds, instead of 80,000 allowed, the law allows only, the AO allows only, or the appellate authority law only with 20,000 rupees. Now only 20,000 should be taxable in the hands of the partner. And therefore, the assessment of partner or the return of partner requires rectification. Okay. But it might happen that 4 years has already left from the assessment year, the assessment year. So what the law says, the period of 4 years shall be reckoned from end of the financial year in which the final order was passed in the case of firm. So you will find everything very logical. Even if you don't read, whatever your logic says, the answer would be same. So in this case, the 4 years shall be reckoned from the year in which the order in the hands of the firm was passed, the final order. And from that date, the partner has 4 years to ask for the rectification of his assessment. Understood? Similarly, rectification of members' assessment consequent to enhancement or reduction of income of AOP or BI. So the income of member is dependent upon the income assessed in the hands of the AOP or BY. And if subsequently the income of AOP or BY is changed, the income of member should also change. And for this, the 4-year period to rectify the income of member in pursuance to the change in income of the AOP or BY. This 4-year period shall be reckoned from the end of the financial year in which final order was passed in case of AOP BY. Similar. Rectification of assessment consequent to disallowance of excess loss or depreciation allowed as a result of proceeding initiated in section 147. So what happens is that I furnish return of income and claiming a loss of rupees, say 1 lakh. In subsequent year, I set off this 1 lakh against the income. Okay, I adjusted this 1 lakh. But subsequently, my return for first year in which I claimed the loss was assessed under section 147, income escaping assessment, and the AO held that there was no loss. AO deleted the entire loss. Then, once the loss is deleted, my subsequent adjustment needs rectification. But it might be a case that 4 years may have been elapsed by that time. So, in this case, there would be automatic rectification, and 4 years shall be reckoned from the end of the financial year in which order was passed under section 147. Logical? Rectification associated on account of capital gain which become chargeable under section 47A. So, what happens in case of capital gain? If an asset transfer between the holding and subsidiary company, then there is this transaction is not considered as a transfer and therefore no capital gain. Provided the holding company holds a share of subsidiary company for the 8 years. So what section 47A says that if during this 8 years, the holding company sell off the share, then the capital gain which was exempted shall be taxable. But now how will you tax it? The period of 4 years has already been elapsed. So there is automatic rectification which says that the period of 4 years shall be reckoned from the end of the previous year in which relevant capital assets were converted or treated as stock in trade, or as the case may be, parent company ceases to hold the entire share capital of the subsidiary company. Logical? So whenever the event has happened which had made the earlier exempt transaction taxable, you will reckon the 4 years from that event. You will add the year in which that event happened and you will add 4 years. Rectification to give effect to TDS or TCS not deducted while computing tax liability. So here what happens is that the deductor deducts TDS subsequently. So it pays, I offer my income, there was no TDS, but subsequently he deducts the TDS on my other payments maybe. So I would have lost the TDS credit because I have already furnished the return of income. Now, the law says, in which case there can be a rectification, and this is a mistake applied from it. But here, here's an interesting point. Here it's silent on the date from which the 4-year period shall be reckoned. So the module says there can be two views. One view is that the 4-year period shall be reckoned only from the end of the financial year in which order sought to be amended is passed. So if in assessment year 21-22 I offered my income on which TDS deducted subsequently say in 25, year 25. So I can rectify the mistake. I can claim the credit of TDS only if there's a time of 4 years from the date when I furnished the return of income assessment was made. Second view is that the 4 years shall be reckoned from the date when I am issued the TDS certificate. Okay. So the module says, the ICAI module says, since this condition is contained in section 155, which provides automatic rectification. In a sense, if you see section 155 is what's saying, is extending the period of 4 years. So if I take a first view where I am applying the 4 year, which was there in section 154 itself. So there was no need to include this condition, these circumstances in section 155 itself. Because this, if I take that view, that 4 year has to be seen from the original order, then it was then 154 as well. No need to separately state it in under section 155. So as per ICAI, the second view seems more logical, and the period of 4 years should be reckoned from the end of the financial year in which the assessee has been issued a TDS certificate. So if I am issued a TDS certificate in 25, the 4-year period shall be reckoned from this date. You are with me? Similar is the case of 6. Rectification to give effect to credit for income tax paid outside India. So if, see what happens in case of foreign tax credit, the foreign tax credit is allowed only if the tax paid outside India is not disputed. Assuming I paid the tax outside India, but I disputed and I want a refund from the foreign government. And the matter is sub judice, is in the court of the foreign government. And after 10 years, the court of foreign government says, no, the tax was rightly paid and no refund is allowed. So once no refund is allowed, I have paid the tax in foreign country. In India, I should have allowed FTC, foreign tax credit. But the return of such income has already been filed 10 years before. How can I now rectify it? At that time, I did not claim because the matter was, the payment was disputed. And the law only allows when the payment is not disputed. So legally, I was not entitled to claim FTC at that time. But now, once it's settled that I was required to make the payment and I had already made the payment, now the FTC should be allowed logically. But how can I allow it? How can I claim it? 4 years has already elapsed. For this as well, the same thing. The section 155 doesn't provide the timeline from which the 4 years period should be reckoned. So similarly, the first view is 4-year period shall be reckoned from the end of the financial year in which return was filed for that year. Such 4 years has already lapsed. Or 4 years should be reckoned from the end of the financial year in which dispute is finally settled. So the most logical part is the second view. And therefore, I say that in this case, the second view could be the time limit 4 years should be reckoned from the end of the year in which assessee files application after dispute in the other country got settled. Going by the purpose of introduction of section 155, it appears that second view seems more reasonable. Okay? Logical as well. Rectification consequent to revision of full value of consideration in appeal or revision, which I just discussed, section 50C. So if stamp duty value has been revised, then the 4 years shall be reckoned from the end of the previous year in which order revising the value was passed in appeal or revision. Recomputation of capital gain on account of reduction of any compensation. If there was a compulsory acquisition of my property and the compensation has subsequently been reduced, then the 4 years shall be reckoned from the previous year in which the order reducing the compensation was passed. So a deduction is allowed under section 80 RRB in respect of patent income. One of the conditions is that the assessee should be patentee. If subsequently a court said that assessee is not a patentee, then the deduction was wrongly allowed and it should be disallowed. But in this case, 4 years shall be reckoned from the end of the previous year in which such order of comptroller or high court as the case may be passed. Hope I am clear. Okay. This is similar to TDS. Now, only two small topics are left. One is faceless proceeding. So, what nowadays happening is almost entire proceeding in the income tax is faceless. I am not required to visit the tax office. Okay. So, what all proceedings are faceless? I'll tell you. And all the assessments are now faceless. I am not required to visit to a tax office. I can file my submission online. Then notice in section 142(1) and 142 are issued faceless manner. Direction to get the accounts audited, special audit, are issued in a faceless manner. Reference to valuation office under section 142A is made in a faceless manner. My 154 and 155 rectification can be made in faceless manner. I told you there are some points where you can apply for rectification online. Demand notice is issued in a faceless manner. Okay. Here we'll discuss in detail the procedure, what happens in case of faceless assessment. So, see, what happens in case of assessment is that what's the mechanism? AO issues notice, assessee submits reply. AO issues notice, assessee submits reply. Okay, this happens in the case of assessment. AO may be satisfied with the reply, AO may not be satisfied with the reply. Okay. So, to make the assessment faceless manner, what the government did, it forms a NFAC, National Faceless Assessment Center. It's a centralized body which governs the entire faceless assessment. Now, there are 4 types of unit. So, it made 4 units: assessment unit, verification unit, technical unit, and review unit. It consists of AOs, AC, DCIT, Additional Joint Commissioner, kind of all things. So, all offices are divided into these types of units, either assessment unit or verification unit or technical unit or review unit. But all communication is done through NFAC, National Faceless Assessment Center. What does assessment unit does? It actually does the assessment. It asks for the information from the assessee. It scrutinizes the information received from the assessee. It actually makes the assessment order. It's the person, is the unit, the officer in this unit actually does the assessment. What the verification unit does? It does the verification. If there is some physical verification which need to be done, then it's done by the verification units. What technical unit does? It gives technical opinion. So there may be a computation of arm's length price for which a transfer pricing officer is required. There may be some expert opinions required on the interpretation of tax treaty. So assessment unit can refer the matter to verification unit for verification or technical unit for some technical advice. Review unit, what it does? It reviews the draft assessment order passed by the assessment unit. Okay. But remember one thing, every communication has to be made through NFAC. Assessment unit, AU, cannot directly refer the case to the verification unit or technical unit. It has to refer the case to NFAC. Then NFAC shall select the technical or verification unit as the case may be and refer the case to that. So all communication is through NFAC. So what happened is that NFAC assigned the case to AU whenever a case is open for the scrutiny assessment, for any type of assessment, so what NFAC does is that it decides an AU and refers the case to the AU. The AU is selected through automatic allocation system, through the computer. So there is no human intervention. Okay. Then NFAC intimates the assessee that your assessment shall be conducted in a faceless manner. Then NFAC itself serves a notice of section 143.2 or 142.1 as the case may be on the assessee. The assessee may file his response to the notice within the day specified into NFAC, which shall forward the same to AU. So, if all communication with the assessee is also through NFAC. The NFAC issues the notice and it receives the reply and then it forwards the reply to the concerned AU. Okay. Once the reply comes, the AU may request NFAC to obtain such information or any other documents from the assessee. In such case, NFAC shall issue the notice to the assessee or any other person from which the information is required. If assessee has filed the response, then NFAC shall forward such response to the AU. Okay. Or AU may ask for some inquiry from the verification unit or ask for technical advice from the technical unit. Then NFAC shall assign the case to technical unit or the verification unit that also selected through automatic allocation system. And whatever report received from technical unit or the verification unit, the report shall be received by the NFAC and NFAC shall forward the report to the AU assessment unit. If assessee does not, but the assessee AO has asked for the information from the assessee. If assessee furnish the response information, then NFAC shall forward the information to the AU. But there may be a situation that assessee has not furnished the response. In such case, the NFAC shall intimate the AU that assessee has not furnished the response. Then AU may request NFAC to issue notice under section 144 to do the best judgment assessment. In such case, NFAC shall issue a notice. In reply to the notice, assessee may furnish the response, may not furnish the response. If he furnish the response, then NFAC shall forward the response to the AU. Very logical, very simple thing. If it has not furnished the response, then NFAC shall intimate that assessee has not furnished the response. Okay. And then AU shall make the draft order. So first it's made the draft order. AU shall, after taking into account all the material on record and prepare in writing, if there is no variation, if no variation prejudicial to the assessee is proposed, so he will prepare an income or loss determination proposal and shall send the same to NFAC. But if he has proposed some addition, then he will prepare a show cause notice stating the variation and shall serve the same on the assessee through NFAC. Assessee to file a response to the notice within the specified time. NFAC shall send the response to the concerned AU or intimate the assessee's failure to respond. Once the AO has submitted a draft proposal, then AO shall, after considering all relevant material on record, prepare income or loss determination proposal and send the same to NFAC. So if he has not proposed, the AU has not proposed any addition, he will submit the proposal to NFAC. If he has proposed the addition, he will issue a show cause notice through NFAC and assessee will reply. After considering the reply, he will prepare a income or loss proposal, which he will submit to the NFAC. Now what the NFAC do? NFAC may either confirm the AU that you pass the final assessment order basis the proposal you made. Upon receipt of proposal from AU, the NFAC may, on the basis of guideline issued by the board, convey to the AU to prepare the draft order in accordance with the proposal. AU shall thereafter prepare draft order. Or NFAC, if he feels so, he may refer the case to the RU, review unit. He may assign the proposal to review unit selected through automated allocation system again. What will the RU do? RU will conduct a review of the proposal, prepare a review report and shall send the same to NFAC. NFAC to forward the review report to concerned AU. The NFAC will send this report, whatever the report the RU has made, review unit has made, it will send the same to the AU. But this report is not binding on the AU. The final assessment done by the AU. AU shall, after considering such review report, accept or reject some or all of the modification proposed therein and shall prepare draft order. So finally, whether after referring to the RU or without referring to the RU, the AU shall prepare a draft order. AU shall forward a draft order to NFASC and NFASC shall confirm it and then AU shall pass a final order and initiate a penalty proceeding also if any. And send this final order and the initiation of penalty proceeding to NFASC, who will send it to the assessee along with demand notice specifying the sum papers. But if it's a case of eligible assessee, the DRP, in such case, NFASC shall serve only a draft order on the assessee. The assessee shall either file the acceptance or will not file the acceptance and will remain mum. In such case, if the acceptance is received, the NFASC shall forward it to the AU or shall intimate that the assessee has neither filed the acceptance nor the objection. In such case, the AU shall pass the final order. If assessee has filed the objection, then he will file the objection to DRP and NFASC. NFASC shall send a copy of the objection to AU so that AU has to wait. Once the DRP direction is received by the NFASC, it will forward the direction to the AU and AU will pass the order in conformity with the direction. And similarly, the order so passed along with the penalty notice or the demand notice shall be served upon the SSC by the NFASC. So everything is done by the AU but through NFASC. Once the assessment is completed, all electronic records shall be transferred to the jurisdictional tax officer of the assessee. The file is maintained by the jurisdictional tax officer. There would not be a physical signature. The all notice, orders, submission are signed digitally. Okay. And all these are communicated. Now there would not be, nowadays we don't receive physical notices. We receive notice on email or on our income tax portal. Okay. There may be a situation where the AU has proposed addition and assessee wants a physical hearing. In such case, only in such case, the where there is the AU has, where the draft order has an addition, then the assessee can request for the physical hearing and it shall be granted to him. There is no discretion, but that physical hearing shall happen through video conferencing. Assessee need not to go anywhere. He will do the video conferencing with the assessment unit. And the chief commissioner or director at NFASC may at any time transfer the case to the jurisdictional tax officer for physical hearing. But for this, he needs approval of CPDD. How prior approval of CPDD may be required. It's very, just for the sake of completion, it's not a very important topic from exam point of view, but it's very practical. We do this day in, day out. So therefore, I discuss this. Whatever happens by the AU, but it happens through the NFASC. Okay. So last topic for this chapter is reference to principal commissioner or commissioner in certain cases, section 144BA. So you know about GAR. What happens in GAR is that an AO, the assessing officer, during the course of assessment, treats any arrangement or any transaction as impermissible avoidance arrangement, and it applies GAR. But it has a very serious consequences, and therefore the government has made that AO cannot decide whether a transaction or an arrangement is IAA or not. He has to refer the case to very much senior officer. So what's the procedure? Let's read it from the module itself. So what happens is that, let me explain you. AO refers the case to his commissioner or principal commissioner, where he feels that an arrangement should be referred to as IAA. impermissible avoidance arrangement. Once the commissioner receives such a reference, he gives an opportunity to the assessee. Assessee made a submission, and if commissioner also feels that the arrangement should be referred to as IAA, then he referred to the case to an panel, approving panel. The panel is chaired by the existing or a retired judge of High Court. It's a very senior panel. It's consisting of 3 members chaired by the existing or retired judge of a High Court. Okay, and if that panel decides whether the arrangement should be treated as IAA or not. If it's held to be treated as IAA, then it passes an order, whether treating it as IAA or not, it passes an order and refers the case to the AO, and then AO do the assessment and conformity of such order. Okay, so AO make a reference to principal commissioner or commissioner at any stage of assessment reassessment procedure on the basis of material evidence available to declare an arrangement as IAA and determine its consequences. The commissioner shall issue notice to assessee for submitting the objection and provide an opportunity of being heard for a period not exceeding 60 days. If assessee does not furnish the objection, does not furnish the response against the object, does not furnish the objection, does not furnish the response, then what the commissioner does is, commissioner issues a direction as he deems fit for declaring arrangement to be IAA and refer the matter to the approving panel. But if assessee furnish the response and if commissioner is not satisfied, then he make a reference of the case to the approving panel. If he is satisfied, then he communicate to the assessing officer that the reference is dismissed, the arrangement cannot be held to be IAA. Okay. Once the case is referred to the approving panel, then approving panel again gives an opportunity to the assessee of being heard. He do the further inquiry, direct the commissioner to make such inquiry. He can call for examine the records, and he can require the site to furnish such record evidence as it may direct. Then, basis all this thing, approving panel issue direction for declaration as an IAA, impermissible avoidance arrangement, and specify the previous year in respect of it is to be declared within 6 months from the end of the month of receipt of reference. Okay, but remember one thing: if the assessee has not furnished the response against the notice issued by the principal commissioner or commissioner, then approving panel shall not again give him an opportunity of being heard. He will pass an order. No appeal can be filed against. Okay, so Sanjay ji is asking for impermissible avoidance arrangement. So this is another topic, and we are here only discussing the manner in which an arrangement is declared as impermissible avoidance arrangement. So there are clear provision you will study in any other chapter where the law in detail discuss what happens when arrangement declared as impermissible avoidance. So what happens is that it generally applies in case of NR. I'll discuss it very briefly with you if you have raised a question. What happens is that, see, if you know there was a Vodafone transaction. Yeah? What was the Vodafone transaction? Vodafone purchased the shares of SR India. Earlier the SR was held by Hutch, and Vodafone purchased the share from Hutch of SR India. Okay, and because of some treaty benefit, the whatever capital gain which the Hutch earned was not taxable in India. Okay, so there the controversy of GAR arisen from such judgment. It was earlier as well, but it arose from such judgment in a big way, and the government tried to say that the Hutch held the shares in SR from a tax haven only with the intent to save tax when it exited India. Hutch was a UK company, it could have held the share from UK, but it held the share from Cayman Island. So it made an entity in Cayman Island, and Cayman Island held the share of India. So who was the seller? The Cayman Island was the seller. So capital gain lies in the hands of Cayman Island, and the Indian Cayman entity doesn't tax such capital gain. And therefore, what the government wanted to say is that the only purpose to incorporate Cayman Island entity is to save tax in India once you sold the share. Okay. So if a transaction was undertaken with the only motive of tax advantage, of tax benefit, it has no commercial rationale, then tax authority may say that it's an impermissible avoidance arrangement. It was not a proper arrangement. It doesn't have any commercial or business rationale, and I will avoid it. In such case, if GAR is involved, then authority could disregard Cayman Island and can say that the shares are sold by the UK company. So I have discussed this in very briefly. You will cover it in another chapter where the GAR is covered. Okay? Here the scope is, if AO feels that there's such kind of arrangement, then how can he declare it? So first he will refer to Principal Commissioner. Principal Commissioner will give an opportunity. And if it's not satisfied, then the Principal Commissioner will refer matter to the approving panel, and approving panel will pass the order as it deems fit. Thank you, Sanjay ji. Okay. So AO shall complete the proceeding in accordance with such direction as may be received from the approving panel. Okay. See, such direction are binding. See, I'll show you the composition of approving panel. Who is the approving panel? Each panel shall consist of 3 members, including a chairperson. The chairman shall be a person who is or has been a judge of High Court. 1 member shall be member of IRS not below the rank of Principal Chief Commissioner or Chief Commissioner. And the third person shall be a member who is an academic or scholar having special knowledge of matters such as direct tax, business accounts, and international trade practices. So such third person shall be the subject matter expert. So it's a very, very powerful panel, and this panel actually decide whether the arrangement is IAA or not. Because once the arrangement is held to be IAA, it's a very serious consequences. The amount involved in this type of transaction are really, really big. Thousands of crores rupees tax impact. Okay. So friends, this complete my chapter assessment procedure. If you have any doubt, today we discuss the TRP, then we discuss the search assessment, then the rectification, then facial assessment, and now the reference to the approving panel in respect of GAR transaction. If you have any doubt about this or the earlier classes, let me know. I'll upload the notes for all 3 classes on the BOS website. So should we conclude, or is there any doubt? Thank you, Sanjay ji, for the nice words. It motivates us as well. Let me know if you have any doubt. I'm really happy to help you. Okay. So for the time being, let's conclude. Thank you. Good night. Yes, sir.